Participants are coming in. Let's see, we've got Hannah online, Maya, Charlie. Let's promote him to panelist.
Do we have Shanice?
No Shanice.
Okay.
How are we doing there?
Are we expecting Shanice then? Or is it just?
She said she would try, but I don't know.
Okay.
Okay, so Charlie's in there as a panelist.
Okay, does that mean that we're
As a
ready?
guest.
All right. Trustee Harris, would you lead us in the Pledge of Allegiance, please?
I certainly shall. Ready? Begin.
I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all.
Okay, the Mendocino County Board of Retirement meeting for September 16th, 2025 is called to order at 8:35. Roll call, please, Judy.
Mr. Kelly?
Present.
Thank you. Ms. Cavanis is absent. Mr. Haschak?
Here.
Mr. Cromer?
Here.
Mr. Shoemaker?
Here.
Ms. Harris?
Here.
Mr. Swope?
Here.
Ms. Cubison is also absent, and Mr. Land.
Here.
Thank you.
Okay, members of the public are welcome to address the board on subjects both on and off the agenda. Public comment is limited to 3 minutes per person and will be allowed at the time an item is discussed. Individuals wishing to address the board under public comment are welcome to do so. And is there any public comment at this time on
There
items
is-
that are off the agenda?
Does not appear to be any public comment.
Okay, then that moves us to item 0, which is we have one trustee who is going to be attending remote, Trustee Kelly. And I need to read this off. Trustees, I have one item to discuss with you that is not on the agenda. Trustee Cupson is requesting that she be able to participate in today's meeting. I'm sorry. Trustee Kelly is requesting that she be able to participate he be able to participate in today's meeting remotely. A few years ago, the California legislature passed a law that allows elected officials to participate remotely if certain conditions are met and the board votes to approve the request. This procedure was memorialized in the board meeting remote attendance policy for trustees that this board adopted in 2023. The emergency circumstances exception to the Brown Act allows an elected official to participate remotely when the official has a medical emergency that prevents them from attending in person. Trustee Kelly, please briefly explain why you are asking to participate remotely.
I don't know what happened to him.
That was me, sorry.
Did he not, did he?
He's logged in, but he is not present to state, so.
Do I need to read this again?
No, you don't need to read it again. I think, Jeff, are we good at moving forward? And when Mr. Kelly comes back to the desk, he can explain his request for the absence to attend remotely, and then we can vote on it at that point.
Yes. I am here.
Oh,
He's
sorry.
here.
Mr. Kelly, you need to provide the explanation as to why you need to attend remotely, because you're sick or whatnot.
I'm suffering a nasty cold and I'm sniffling and coughing painfully and just don't, I'm not a good person to be in public in a closed meeting room.
Thank you.
Okay. Okay, Trustee Kelly, the law requires me to ask you if there are any persons in your house that are age 18 or older, and if so, who they are.
Wow.
I think it applies only in the room, but.
Okay.
Well, there is a spouse here, much older than 18, but she's not here at this point.
Okay. The other conditions are satisfied, which includes that the quorum of the board is present. There is a quorum. And the public is able to participate remotely, and that is true. Are there any questions from trustees?
I see none.
Okay. Do we have any public comment?
There is no Thank you.
Can't vote.
He can't
You
vote.
can't vote, okay. Good. Mr. Haschak.
Aye.
Ms. Harris.
Aye.
Mr. Swope.
He's not voting yet.
Oh, you can't vote. Correct. Mr. Land.
You will
Aye.
later.
Okay, that brings us to item 1, consent agenda. All matters on the consent agenda are to be approved by one action without discussion unless a board member requests separate action on a specific item. Does any trustee wish to pull an item from consent for discussion? Seeing none, is there any public comment?
There is no public comment.
Okay, the consent agenda is approved by unanimous consent. That brings us to item number 2, investment matters. And the first part up, A, is the core real estate manager discussion. Callan, Greg DeForest, Claire Tellen.
Good morning.
Good morning.
Great. Well, we'll provide a brief introduction here before the core real estate managers come in for interviews. But just by way of background, as you'll all recall, we've been working through the real assets structure of your portfolio. So we spent some time in May evaluating the structure, reviewing the current managers, and talking about potential evolutions of the structure. At the last meeting in August, we reviewed the finalists for 2 real estate searches that we conducted as a result of the previous discussion. So one for a core real estate manager and the other for a core plus manager. Now, what are we doing today? Core, we're going to hear from today the 3 finalists that we reviewed at the last meeting, and that's Barings, who's the incumbent, LaSalle, and Principal. So there's 2 pie charts on this chart, on this page here, and the one on the left, we're not making any changes there, and 2 core real estate managers, so that's Barings and DWS. As we've discussed in the previous meetings, this core real estate manager search is potentially to replace Barings within this structure. So again, you're going to hear from Barings today. They are your incumbent, but we're looking for a manager to complement DWS, the other core real estate manager in the structure. Now, what you see on the right-hand pie chart is a potential alternative structure to what we currently have, and that includes a new allocation to a core plus real estate manager. So we still think that that is a good direction to move in. We'll be looking at, or we'll be interviewing the core plus managers at the next meeting. So we still think that's the right direction to move, but today we're just focused on the 3 core finalists, hearing from each directly, and again, selecting a complement to DWS among those 3. Pause there to see if there's any questions, and then turn it to Aaron for a quick highlight of the additional materials that we have and maybe any comments on the 3 managers we'll hear from.
Great. If no other questions there, we have a number of slides in the deck that show kind of some of the key characteristics of each of the managers, and then also some hypothetical combinations of those managers. So just on this chart here, and we don't have to go in depth, but I just want to use this to kind of illustrate some of the differences among the 3 groups that you're going to hear from today. On this chart, we show the DWS and Barings combination in the blue bar. That's your current portfolio. In the green bar, you have a combination of DWS and Principal. In the orange bar, DWS and LaSalle. And then in the tan bar, that's the Odyssey benchmark. So this just kind of gives you a flavor for what these hypothetical portfolios would look like if you were to combine your current manager, DWS, with any of the 3 candidates that we're looking at today. Some of the key things that I would point out here are, while Principal, it looks like they have a DWS and Principal combination has an underweight to the multifamily sector. Principal does have a lot of alternative housing. So if you combine that traditional multifamily with what they have in single family rental and manufactured housing, student housing, that really gets them to about an equal weight to the Odyssey index. And then, with some of these other sectors, you have an underweight to office, pretty much with any of these combinations, but particularly with LaSalle, given their underweight. And then LaSalle also has a pretty significant overweight to the alternative sectors, so you'll see that show through in the orange bar on the far right. The alternative sector allocation is something you're going to hear a lot from LaSalle today, and so I think while all three managers do some alternative property sector exposure, LaSalle's is certainly higher than the others. So one thing we just wanted to highlight there is, as Claire mentioned, with the Core Plus search that we're, potentially reviewing next month, and those candidates that we discussed last month in the Core Plus space, there's a lot of alternative sector exposure that you'll get from a potential Core Plus allocation. So just want to keep that in mind as we think about the potential combinations of the core managers, the groups that you're going to hear from today, and just kind of keeping that in the back of your mind that a lot of these Core Plus managers that you'll hear from next month also have a lot of alternative sector exposure.
We have a question.
The alternative sector is excluding industrial, multifamily, retail, office?
Yes, that's right. It's kind of a catch-all for everything else, but you'll see on the footnotes here, we list out specifically which sectors each of those different managers has in those alternatives. So for example, Barings is life sciences, self-storage, and then a debt investment. And you'll see that for the other two candidates as well.
And we'll come back to some of these charts following the interviews. But again, just keep in mind, we're looking at core today, and at the next meeting, we'll look at core plus. So we'll bring some of that back as well.
We can keep moving on some of these charts, but I think it might be helpful to kind of go back to these after you hear from the managers, and we can kind of go through some of these different characteristics. So if there are any questions about the specific managers that you're going to hear from today, I know we spent a lot of time talking about them last month. So if there are any other sort of lingering questions that you want to address before those managers come in and speak to you, we're happy to address that now.
Questions? Okay, seeing none. Are we proceeding then to the presentations, or do you have more?
I think we're ready to proceed to the presentations.
Okay. All right, that would bring up item B, and that's Barings. Good morning.
Is there assigned seating? Yeah. Perfect.
So this is Chris Berry. He's the portfolio manager on the strategy.
Take your chair.
Thank you.
Welcome, Chris.
Thank you so much. Appreciate you having me. I hope you have the presentation materials, etc.
Yeah, give me just a brief moment.
Perfect.
This stuff is always in the way.
How was your drive?
It was great. I flew into Sonoma last night, to Santa Rosa last night, and the drive up here was gorgeous, actually. I used to live in the Bay Area, and so I would come up here all the time, mostly to cruise out to Fort Bragg, because the coast is just gorgeous up there. So this is actually kind of a nice trip down memory lane doing this again. So appreciate it. Well, awesome. Thank you for making time today. As you pull up the presentation materials, we've got the stuff here. And so the beginning part of this deck really kind of has some more firm level stuff. I know you guys are familiar with us, and so I won't spend a whole lot of time there. I'll give you the 45-second version of it too. But flipping right into, I think it's page 4 or page 5 of the deck. This really just begins an overview of Barings as a platform. As you can see, we are a global investment manager, roughly $400 billion assets under management. Flipping over to page 6 very quickly, you can see that our investment capabilities kind of span from public to private to real assets. And the real estate group, which is what we're focused on today, is kind of encompassed in that last category on the right side of the page. Getting into the next page really kind of gets into our real estate platform more specifically. Today we have roughly $60 billion of assets under management. We do debt, we do equity, Probably the biggest thing I'd focus on too is that in terms of investment style, we invest across the risk spectrum. We do core plus, value add, opportunistic, all of which we do within this account as well to varying extents. Probably the other big thing I'd point out too is in terms of alignment. Our parent company, MassMutual, they invest alongside our investors in all of our investment products. They're actually a significant investor in the Barings Core Property Fund. I'm invested in the fund as well. Hopefully that demonstrates alignment with you as investors, but certainly MassMutual's presence, we think, adds stability to the platform. The next page, I'll probably focus more specifically on the U.S. real estate platform. Roughly a third of our AUM is in the U.S., and the Barings Core Property Fund is one of the larger platforms within that exposure. A very exciting thing I want to point out on the next page, I think it's page 9, goes into our recent acquisition of a company called Artemis Real Estate Partners. We closed this acquisition back in the spring. Artemis basically added about $12 billion of assets to our platform, 100 people as well. We are going through the integration process on that right now, but I am super excited about it because really, as we thought about these last couple of years, Barings has wanted to find investment firms that had specialization that could really focus on some of the niche property sectors, such as senior housing, medical office. I'm sure Aaron and his team at Callan have also talked with you guys about, diversifying into alternatives these last couple of years as well. And so we had the same idea. And so we went out and found people who were really good at doing that. We're going through the integration right now. It'll probably take 12 to 18 months. We're not going to wait till the end of that, obviously, to do that. It's already happening right now. Our acquisitions people, our asset managers are already starting to work with them. We're already looking at each other's investment committees. Frankly, from our fund's perspective, very selfishly, I'm interested in seeing it happen very quickly because, again, it'll give us exposure to asset types that we have a lot of interest in doing, but frankly, the platform wasn't doing a whole lot of already. And so this is a good capability for us to add. The next page goes into the fund team itself. I'm Chris Berry, the portfolio manager of the fund. I've been with the firm now for 11 years. I've worked on this fund specifically for the last 8 years. Probably the biggest news I'd share with you, and we've already disclosed this multiple times, but my former co-PM, Deb Schwartz, left the firm back in June, really just looking for kind of the next stage for her career. Deb's close to retirement right now, so she was looking for something a little more kind of less stressful in terms of her life. She's actually working for the housing authority in her hometown that she grew up in, and so she's happy to talk with anyone who wants to kind of get her opinion on the fund going forward, the team, etc. But Deb is very amicable with us as well, and so Deb and I worked very hard these last couple of years to really reposition this portfolio. Something that we'll talk about a lot throughout today. And so now that repositioning is basically done, it was a good time for her to step back. And so I'm kind of jealous with her. I'm happy that she was able to do it though. And so she left the fund in a good spot. So today, the team consists of myself, Emma Carlone, you can see on the page, our fund analyst, Stacy McDonald, who's our fund admin. She's great in terms if you have to get investor statements, access to the data room. If you just have questions, she's a great resource for as well. And then we've got 3 dedicated accountants in our, controllers in our accounting group. I'd also point out that we are supported by the acquisitions, the asset managers, the capital markets people, the researchers that you can see on this page. All these folks are located in our regional offices. They're close to the properties in the portfolio. And really what that allows us to function as, and it's different from a lot of our peers, is that we can be more of an operator as opposed to just simply a capital allocator. When you think about this fund specifically, almost all of our properties are wholly owned. We've only got about 15% JV exposure in our portfolio. And so, why I think that's important is that, really want to make sure that, the manager that you hired is controlling all the day-to-day. We control major decisions. It's not some partner that you've never heard of. And I think particularly as you get into times of the real estate cycle like we've had these last couple of years, where valuations came down, all of a sudden you're working with a partner who was incentivized to work really hard because he thought there's a lot of profit for them. That profit goes away, and you always worry about them. Are they going to still be focused? Because we control decision making with our portfolio, that hasn't been an issue for us. We can always make sure that things are getting done. And so the next few pages in the presentation go more specifically into the fund. Please jump in if you have questions. I always prefer being interactive. I don't want to kind of just preach at people for the next 20 minutes or so, but really we're excited about where the fund is positioned today. Really on this page, these last 2 years have been a time of transition for the real estate sector. We think that the relative performance that we've demonstrated really kind of proves out that the tough choices that we made were correct in terms of repositioning this portfolio. And certainly, we think that the fund is set up for success kind of on a go-forward basis. When you look at the fund since the start of last year, we have outperformed the Odyssey every quarter since the beginning of 2024. On a trailing 1-year basis, we've beat our index by nearly 200 basis points. That's basically top quartile performance. One thing I'd point out as well is that we've had outperformance on income in this portfolio as well. And the reason I think that's important is because people still have some questions about valuations. Is this property worth $100? It's worth $90. It's tough to say at times, but income is income. There's no way to really kind of game that. Either the properties are well leased and you're collecting your rents, or you're not. And so I think the fact that we've had strong performance on income kind of speaks to the durability of the portfolio. I'd also point out on the page too that at Barings we really think that in terms of kind of the next phase of the cycle, we think that this fund is set up for success. I have really strong conviction about that right now. In terms of what we did, we've achieved overweight allocations to sectors that we think have the best prospects going forward. Residential, we are overweight, retail as well, industrial as well. We've got very low office exposure, and I think even though we've seen a lot of work that's been done in terms of getting people back to the office, it's still taking a long time to actually get that done. People are still working from home, and so having that very clear underweight allocation to office, I think, is something that's helped our fund, and certainly has been a key part of our success this last call it 18 and 24 months. But the other thing I'd point out too, in terms of where we're going, we've got a lot of growth baked into this portfolio. Over the course of the next 4 years, we expect that NOI, our income, is going to grow by about 30%. That's based on organic stuff that we're doing in the portfolio. That's leasing up our newest properties. That's as leases expire, basically rolling those leases up to a higher rate, as well as doing some renovations in our portfolio. So we've got a lot of the income that's baked in, or income growth that's baked into the portfolio. The other thing I'd point out too is just in terms of valuations, we think that the fund is really sensibly valued right now. We're marked at roughly a 4.7% yield. I think that looks pretty attractive relative to the 10-year. And certainly, as we'll dig into in the presentation, we think that looks really attractive compared to our peers in the index, who are still, frankly, particularly in the office sector, using valuation yields that just, frankly, don't make any sense when you see where stuff is actually selling at in the market. And so we think that we offer a strong relative value there. Last thing I'd point out on the page, hopefully Robert can attest to this, but we really do value our relationship with Mendocino County. You've been a key investor with us since 2011. Both yourselves as well as your consultants at Callan always ask us really good questions, perhaps a little too tough at times, but we do appreciate that. Based on your size in the fund, you are eligible for a seat on our advisory committee. We meet typically once a year in November. You can do it virtually or in person. We do it typically in the Northeast. We know it's kind of a commitment for people. It's not a whole lot of work, honestly. If it's something that you're interested in doing, please let us know. I want to formally extend that invitation to you as well. If you think it's too much of a time commitment, obviously you can also designate your consultant to participate on your behalf, just to listen into the discussion. But really it just gives you more access to other investors, and you kind of hear about where the fund is going a little bit quicker than you do just listening to our quarterly calls. And so obviously you don't need an answer on that now, but something that Stacy McDonald will follow up on with you to see if it's interesting to you to participate. So I wanted to make sure I threw that out there. Please.
How long was that eligibility for the advisory seat?
It's open right now. We basically have an open seat.
But I mean, has it been a few years?
Gotcha. So basically everyone has a 2-year term. We had one investor that just kind of fell below the threshold just recently. And then we had another investor who basically just doesn't have time to do it. And so it's open right now. But people are elected for 2-year terms. Again, it's not a whole lot of work. It's just mostly you get to hear more of what's going on behind the scenes at the fund. Sorry.
2% life science, is that you?
I'm sorry? In terms of life?
2% life science?
In life sciences, in our portfolio is roughly around 6% or so of our fund. That's right.
What does that entail?
So we have one life sciences property. It's located in suburban Boston. It's 100% leased to 4 tenants. This is a property that we bought kind of during this latest tumult, so we actually got a really good pricing on it. We've currently marked that property at roughly a 5.7% yield. When you look at our index is carrying life sciences at close to a 3.7 cap rate. So I don't know how they justify that. Frankly, we've talked with a group called MSCI that does kind of benchmarking across the index. They basically have shown us is that over the course of the last 2 to 3 quarters, people are keeping their valuations where they're at, and their occupancy is going down, which just means their income's going down. And so they're keeping the same value, but they have less income, and so the yield's going down. And I don't know how you justify that, frankly, but people are doing it. And so we're not doing that with ours. Our property is 100% leased. We've got nearly 5 years of remaining lease term on it, and so we think that our exposure is pretty well mitigated. In Boston, despite everything that's happening right now with life sciences, Boston is arguably the #1 STEM market in the country, and so we're pretty excited about the asset over the long term.
I think the Bay Area might take issue with that.
Oh, I won't argue. It's definitely Boston, San Diego, the Bay Area. 1, 2, 3. Choose your order on that.
I would point out for trustees, the Boston is certainly one of the top markets for life science. San Francisco is the other one, San Diego.
That's right.
And so we'll kind of see that theme a little bit with all the managers today.
That's exactly right. Well, flipping over to page 13, this gets more into an overview of the fund as of today. In terms of our stats as of Q2, the fund had $2.5 billion in gross assets, 29 investments, 14 markets around the country. So as we think about our portfolio, we like to say that we offer very good diversification with this portfolio, but in comparison to some of the really big funds in the Odyssey, we're able to be a lot more nimble in terms of being able to choose our sectors, choose our markets, and be a little more focused. And so that's one of the things that we like about our portfolio, and I think that's something that we offer that's a little bit different than what you get from a lot of the other funds in the index. In terms of operations with leasing, our core commercial portfolio is 95% leased. Even when you lump in our apartments, our self-storage, we've got a couple properties that are leased up, we're still about 90% leased overall, so very stable in the portfolio. In terms of leverage, is a topic we'll talk about a couple of times today. We're currently 24.9% levered. That's within our target range of 20 to 25%. I'll note that our index is a little bit slightly more levered than us, kind of somewhere between 26 and 27%. The thing that I kind of like about what we've done is that we really focused to kind of build up capacity to be able to tap into some floating rate debt in our portfolio. And so if interest rates do start to come down, and hopefully at some point in the next few hours we'll start seeing some cuts, that'll become more accretive over time. But we basically have paid down a lot of that floating rate exposure in the portfolio, but we have the capacity to redraw it if it becomes a little bit more accretive to us. And so that's something we've got that we haven't tapped into yet in terms of liquidity. Please.
You have nothing in the Midwest?
We do not have it right now. It pains me to say, as someone who grew up in Michigan, and I'll talk about that a little more in detail, but in general, what we've done with this portfolio over the course of the time I've been working on is that we've really reallocated exposure from the Midwest, which primarily is just Chicago, frankly. A lot of us invest in Chicago. Chicago has a very challenging tax situation. Zoning is also a bit of a challenge there as well. And so what we've done is we've reallocated exposure out of Chicago as well as some of the mid-Atlantic states such as Washington, D.C. And we've allocated that exposure more to the south as well as to the west. We still have kept our clusters around Boston, again, because it is a very strong innovation market, as well as around for industrial in New York, because it's, again, one of the largest ports in the country as well. But in terms of Chicago and the Midwest, we haven't done as much there because you can get good income at times, but the appreciation of the long term just isn't there. So the total returns are usually a little bit lower than the rest of the index. Rest of the country.
How does Artemis merger affect that map?
The map looks very similar. They do have exposure, though, to some more Midwest states, and so they've got some more exposure in places like Kansas, Missouri. They've got some stuff in the upper Midwest as well, which makes sense from an industrial standpoint. But otherwise, in general, they are focused on the same markets that we are as well. I'll point out on this page, too, one of the kind of the big things that we're talking about with the index these days is just capital flows. Capital flows have been really challenging for the Odyssey Index. I mean, frankly, it's been really challenging for real estate in general these last couple of years because of where interest rates are at. We haven't been immune to that. We do have a queue right now of about $443 million. We have made significant progress paying down that queue over the course of the last year. It's down significantly. As we think about the next couple quarters, we've got, 1 or 2 transactions that are in the pipeline that we think will make, another significant dent into our redemption queue. I will say, though, as we approach 2026, our base case capital plan has us paying off our redemption queue by the middle of the year. We've got transactions lined up to be able to do that. I want to be very prudent, though, about addressing that queue. I don't want to react to it very, very quickly because, frankly, based on the performance of the fund recently and the strong performance we've put up, we've been starting to have more conversations with investors about coming out of the queue. I'm optimistic that we can get people to do that. I frankly, though, don't want to put into my capital plan and bake everything on that. Otherwise, I'm basically going to plow forward with the plan we've got to address the queue by the middle of next year. But we're kind of optimistic that we won't have to do as much as we think we have to right now. But we are addressing that queue. We've brought it down significantly. We're trying to be responsible and balance the interests of people who are sticking with us as well as people who are looking for liquidity. So that's what we're doing there. The other thing I'd point out on this page really quickly too, and there's stuff in the back of the deck that talks about it, but I like to mention up front, sustainability is really important to us in this fund. It's not anything political for us. We're basically trying to make sure that the portfolio can stand the test of time. You think about things that have happened in terms of wildfires in Southern California. You think of extreme weather events, hurricanes in the southeast. None of that has impacted our portfolio. That's by design. It's something that we really focus on, particularly making sure that the portfolio can be as energy efficient as possible, because that does filter down to our tenants, and they appreciate that the buildings are a little more efficient. We think about our GRESB ranking, which is locally known as the Global Real Estate Sustainability Benchmark. We are number 1 out of 60 core diversified funds. It's really tough to do that. It's a lot of competition that's out there. We've been number 1. We've been actually in the top 3 for the last 5 consecutive years. And so it's something that we pride ourselves in as an organization. We're really focused on. So the next few pages, I'll go kind of quickly because I know we've touched on a lot of this stuff before, just in terms of portfolio composition. In terms of our sectors right now, residential is about 1/3 of the portfolio. That's overweight relative to our index. It's something that we've always leaned into. We've always had a high concentration of residential in this portfolio. Where we're a little different from our peers in the index, though, is that we have focused on more on the low-rise kind of garden-style apartments. We've seen that over time that people prefer to have more space. We look for properties that have larger floor plates, lower density properties. We don't have anything in the portfolio that's really urban at this point. What we focus on are kind of those first ring suburban locations just outside of the major cities. So people can still get access to jobs, but they have a little more space, better quality of life. And so we've seen that combination has done the best over time, particularly coming out of COVID, and that's what we've leaned into. Our portfolio is 94% leased. It's basically been 94% leased for all of the last year as well. And so we think that kind of proves out that the strategy makes a lot of sense for tenants as well. In the industrial portfolio, we're overweight as well. Roughly, about 3.7 million square feet of industrial space in the portfolio. We focus on warehouse properties primarily in port markets, regional distribution markets. 80% of the portfolio is located in markets like Los Angeles, northern New Jersey, Miami, Dallas, Bay Area as well. We've got a really strong property down in Oakland that we're happy with. And so we think the portfolio has a lot of upside in terms of income. Over the course of the next year, it's going to be a big driver of income for the portfolio, what we're doing in that portfolio. Retail is another kind of cornerstone aspect of our portfolio. It's about 16% of our portfolio. It's overweight relative to the index. I'll point out, though, that retail is a sector that's really in favor for a lot of funds in the Odyssey right now. A lot of funds are very, very far overweight, and some that are kind of at a similar level with us have a lot more, what I'd say is not necessarily the daily needs retail that you want to be in. There's a lot more malls, a lot more power centers, stuff that we think is a little more susceptible to what's happening with tariffs. In our portfolio, we're 75% gross anchored. We are exclusively kind of neighborhood community centers. We're 95% leased. We've got 5.5 years of WALT in our portfolio. Our retail does really, really well for us. And as you think about kind of tariffs and the impact there, from a composition standpoint, food and healthcare tenants are roughly 70% of our square footage and 65% of our revenue. And you're thinking about what's most insulated from tariffs, that's exactly what you want. And so that's what we focused on for this portfolio. Please.
Can you talk about what's the real big difference between the mall and a grocer anchored?
Sure.
I mean, is it just that there's just one building with everybody inside? It's not open? I mean, what's the real difference there? Because this comes up a lot.
Sure. Yeah, typically what you've seen, like we were all growing up, people go to the mall, it's a big enclosed building, all the shops are there, sometimes it's 2 or 3 levels, everyone hangs out there. What we've seen over the last, call it 25 years though, is that shoppers really don't want that experience as much unless you put a ton of capital into the malls. And so if you think about the US right now, there's probably a dozen, maybe 15 really, really high quality malls that people actually spend a lot of time in. For the most part, what people are doing with these malls now is redeveloping them, making them open air, particularly in places like California, right, where you can be outside, every day of the year. And so those types of malls is what I'm talking about, kind of the big kind of blocky centers where you've got a lot of kind of soft goods tenants, clothing stores, things like that. When you think about what we do in more grocery anchored centers, typically you'll see the grocery anchor that's there, the Safeway like you've got down the street, you've got Whole Foods, places like that. And then you'll have, maybe the other half of the center is kind of the smaller shops. You'll have, the yogurt shop, the place you go to get your glasses. You've got a Subway, the Jersey Mike's will be there as well. We've got a lot of inline tenants. And so in those sorts of tenants, in those sorts of centers, really you've got the grocer drawing people in. You have to go there all the time. Most people are still going into stores physically. They're not just shopping online there. And while they're there, they'll say, oh, I need to go get my contacts. I'll go over to that guy over there. Or I'll go to the massage place that's on the corner there. Or maybe there's a Starbucks that's in the parking lot as well. So those are the type of centers that we're talking about. And those type of centers, more daily needs, a little more resistant to competition with the internet. And that's where we focused in our portfolio. I'd say with the other sectors there, very briefly, because they're not huge parts of the portfolio anymore. Office is only about 7% of our portfolio right now. That's roughly half the concentration that we see in the index. Significant underweight. We only have 2 properties left in the portfolio. Both of them are located in Austin, Texas, which again is a very strong innovation market for us. We've got 2 properties. One of them is 100% leased. We built it during COVID. 100% leased to a great company that I can't say specifically who they are, but they're very integral in terms of making these. And so it's a very strong tenant that's at that building. And our other property is just across the river in Austin, which we basically went through a pretty significant repositioning over the course of the last year. We're leasing that property back up. I'm not in love with the property. As soon as we get ourselves, probably back to about 85 to 88% lease at that property, I'm going to sell it next year. But when you look at our overall office portfolio, we are 86% leased between those 2 buildings. That's about 700 basis points higher than our index. And so when you look at our office portfolio, we're higher leased and we've got a higher yield in our portfolio. So I think that does speak to kind of the comfort that we have with our office exposure. Similarly for life sciences, I talked about the one property we've got in our portfolio, about 5% of our exposure. Not a huge part of the portfolio, but it is a very solid income contributor to us. We don't have to put any capital into it. It's just kind of collecting the rent checks every month for that property. Self-storage, we've got a great property down in Los Angeles called Main Street Self-Storage. We basically built this property from scratch. We've just now reached 96% occupancy at the asset. And the nice thing when you get a self-storage asset at that point, now you can start really cranking up the rents there, which, as someone who uses self-storage is not kind of where you want to be at, but people typically pay the rents because it's not a huge dollar amount every month. And so we start getting some pretty strong rent growth out of that asset. And then also in terms of mezzanine debt, it's a little bit different for us in the index. Not a lot of funds have exposure to that. Because Barings is also a lender, we have access to our debt pipeline. And so at various times in the cycle, we'll see that debt is actually pretty attractively priced. We don't do a lot of it. Typically, it's never more than kind of 0 to 2% of our portfolio. But over the course of our fund history, we've round-tripped 7 or 8 mezzanine debt investments. We've achieved an average return of 13% IRRs on these. And so it is pretty juicy. It goes straight to our income return, which goes to pay dividends. And so it's a nice thing that we can do because we do also have a lending arm within our company. The next page looks more at the geographic diversification. I already kind of touched on this before, so I won't spend a lot of time there. But again, roughly 75% of our portfolio is in the South and the West. We've also got those clusters in the Northeast around Boston and the port in New York, New Jersey. And again, that just reflects our house view that there's a little more growth in those innovation markets that are in the South and the West, as opposed to being more allocated to the Midwest and the Mid-Atlantic states. The next page, page 16, goes more into transaction activity, kind of in as well as our investment pipeline. I'd say in terms of recent investments, what we have focused on are more bite-sized industrial assets. We're not buying kind of the big chunky properties. That's probably, if you hear about kind of distress in industrial right now, It's some of those larger assets kind of way out in the Inland Empire. That's not what we have in our portfolio. We've got a lot more kind of risk mitigated approach to industrial investments. One I'd highlight is called Smoky Hollow. This is a property that's about 2 miles south of LAX in Los Angeles. This is a property that we've been basically redeveloping. We had 3 existing buildings on the campus. We go on, renovate a building, lease it up. We have now completed the 3rd building at that campus. We actually haven't even completed it yet, technically. We've already leased all the buildings at the campus, though. And so we're still actively working there, but essentially it's been de-risked at this point. We've got the ability to add an additional 20,000 square foot building at this property. We're already talking with one of our existing tenants who wants to take that building as well. The rent they want to pay is about 40%, well, they don't want to pay it, but we're asking, is about 40% higher than what we underwrote at the property. And so you hear about distress in industrial. If you have the right industrial assets, you can still do very well, and this is a great example of that. In terms of dispositions, it's been pretty balanced across our portfolio. We don't want to skew our diversification targets since we're essentially where we want to be at right now. But I will highlight in terms of recent sales, Weston Road Shopping Center, which is a retail asset in South Florida. This is a property that we turned into a grocery anchor center during COVID. We were able to sell that property in Q2 at roughly a 15% discount, or premium, over where we had the asset marked at the beginning of the year. And so very strong result there. And then Blair Road, this is a great example of what I'm talking about in terms of achieving upside through leasing. This is a property that we bought for $65 million during construction, so it was vacant. We leased it up to 100% occupancy very, very quickly. Over the course of the last 8 years, we've turned the rent roll a couple of times. We were able to sell this property for $140 million in Q2. So a very strong return for the fund, roughly 2.5 times what we paid for this property. So a good outcome there as well. In terms of investment pipeline, what we're thinking about for the future, I'm being cautious with new acquisitions because of everything that we're seeing happening in the macroeconomic environment. But I do fundamentally think that now's a good time to be looking at new investments, because where you can buy at right now, the yields are high enough that you can actually generate a pretty strong income return at these properties. And then as the markets start to stabilize over the course of the next couple of years, there's appreciation, particularly if we start getting some cooperation with the Fed, cap rates come in a little bit. We think there's going to be a pretty strong performance coming out of these types of properties. And so we're pretty active out there looking. Right now, even though I don't have it on here, probably my biggest priority is looking for self-storage. I talked with our partner on our Main Street property just 2 days ago. We've got 3 interesting properties that are coming up in Los Angeles that we are thinking about rolling into. So that could probably hit the pipeline next time we do one of our quarterly investor calls. And so it's pretty interesting right now. The next page, the next few pages really kind of get more into sector positioning and where we're going on a go-forward basis. I won't spend a ton of time there because I've already kind of touched on it, but really kind of the big things over these last couple of years, we increased our industrial exposure by almost 20%. We brought office exposure down by over 25%. Kind of looking forward, we're basically at our targets in the major sectors right now where we want to be at. We've got those overweights in residential, retail, industrial. We've got the clear underweight in an office. Really the big focus, right now for us going forward is really boosting that alternatives. Again, self-storage is going to be a big part of that, but also with Artemis, doing more medical office, doing senior housing. That's something I'd also like to bring into the mix with our portfolio that can help us boost that alternatives exposure.
I'd like to actually go back just one page.
Please.
In the pipeline, just noting a lot of residential there.
Yes.
Overweight generally, I think that's a great thing. But can you talk a little bit about the sort of pipeline and what you're looking at in terms of the residential areas? They're in the West, San Francisco, Palm Beach, Seattle. Can you just kind of talk about that?
Sure. With residential, it's an area that, again, we've leaned into long term. If I was scouting the organization, I'd say Barings has been very, very good with residential strategies over the long term, both development, value add as well. Certainly we've had good success in our fund doing it. And so it's something we want to lean into more because we do see that given the affordability challenges, which I just don't see going away anytime soon, you're pushing more people, unfortunately, into rental, either being in apartments or in single families for rent. That dynamic isn't going to change anytime soon, and so we're pretty bullish on the long-term prospects for residential. We are continuing to lean in, though, and focusing on markets where we think there's strong growth. We have been looking at, again, those more suburban nodes that are close into job centers. We're also particularly looking at markets where there is high single-family housing costs. And so from a rent versus own perspective, it still is influencing people to look at renting. And so that's what we're leaning into. So when you think about what's on our pipeline, looking at a location like in Seattle, this is a property that's just north of the city, a great location with good live, work, play dynamics, but it's not directly in the city, the center of the city. That's a great example of what we're looking to do at. Talking about Palm Beach, it's a property that's there. Again, kind of one of these emerging nodes in the South that people want to be in because, set aside the political side of it being so close to everything that's happening down there as well, people do like being in Florida just from a quality of life standpoint. So that's the market we're looking at. I don't put everything that's on here on the pipeline as well, but we've seen interesting residential opportunities around Boston as well. I'd like to do some more in Dallas, frankly. We've got an existing asset that's in Dallas right now that's very close to a place I lived at one point in my life that I know pretty well. I'd like to do more down there because we are seeing a lot of job growth in that market as well. And so residential is an area that we want to lean into. But we, again, to your point, we are overweight right now. Our target is to be somewhere between 30 and 40%. We're at 33% right now, so we do still have capacity to increase that if we want to. I'd very quickly skip over to page, I think it's page 18, which looks at the regions. I kind of covered this before, but again, talking about where we're going right now. Again, it's focusing on those innovation markets, primarily in the South and West. Really, as you think about our exposures right now, really kind of the places I'd like to lean into more. I'd like to find another opportunity to find an asset in the Carolinas, particularly around Raleigh-Durham, perhaps do some retail in Atlanta. Salt Lake City, even going back to the days when I worked in acquisitions, has been a market I've loved, and I think we've seen a lot more interest in that market, particularly in the last couple of years. Particularly for me, I think I'd like to do some residential, perhaps industrial in Salt Lake City, because I see a lot of good things in that market there. In the Bay Area, right now we've got 2 dots there, even though we call it just one market, San Francisco Bay Area. We don't have anything formally in San Francisco and Oakland right now. We do have something that's more in Silicon Valley, and so we'd like to do some more around the Bay Area as well, because I do think long-term it's a great market. See a question?
Yes, what considerations do you have in identifying target markets?
Sure. And so, one of the big things that we do and that we've worked on, working with our research group, is basically trying to figure out what do we think are the leading indicators, the long-term drivers of outperformance. And what we've kind of narrowed in on are markets that rank very highly for educational attainment, for job growth, for household income growth as well. And so basically we work with our research group and our strategy group to basically screen the top 50 markets in the country. And we screen those down. That's how we developed our target market list. And so when you look at those markets, they typically rank very highly for job growth, for population growth. And frankly, too, one of the nice things about the South, although it's probably a lot is clear now, is that typically you're seeing a lower cost of living in these markets. And so that's driven a lot of people to go to these markets. And so that's kind of how we've screened the market. So looking at those growth drivers. Sure.
And how do you handle the availability for insurance?
It's a big question, particularly in Florida, particularly on the residential side. 2 things. You've heard a lot for insurance in Florida. It's been very challenging. We don't necessarily have residential in coastal Florida. The only residential asset we have in Florida that's residential is located in Orlando, which is a market I actually like to lean into more. We've got residential, industrial, and retail in that market. And we've found that Orlando in particular has been kind of a comparative discount to Miami, to places like that, where people are getting a little bit priced out right now. But in terms of insurance, though, whenever acquisition people bring us new investments, it's kind of the first thing that we ask, can we get insurance for this? Have you run it by our in-house insurance people? We have, because we are an insurance company, our parent company is, we have an in-house risk management group that's very good at managing that for us. And if it doesn't make sense from that standpoint, we just tell them to pass on the deal and move on. Particularly as we think about Florida, too, from the industrial standpoint, these are triple net lease buildings, and so the insurance cost goes directly to the tenants. If the cost is going to be so high that we're not competitive in the market, there's no point in us doing it, right? We're never going to lease the building if that's the case. And so that's what we think about. In terms of California, we haven't really seen as much pushback there. Candidly, we heard from our insurance group that for this fall, we're actually going to start to see our premiums come in again about 4%, which is kind of, a nice fact pattern for us because we've been doing a good job of managing our costs and having realistic replacement cost values in our portfolio. And so the insurers know that we're not gaming the system. And so we're actually getting a little bit better pricing this year. That should flow through into our budgets for 2026. I point out maybe on the next page just very quickly, and I'll go through these next few pages very quickly because we've already kind of covered a lot of this. In terms of kind of the structural aspects of our fund, specifically thinking about leverage, non-core, JVs. I touched on leverage before. For our core fund, we're not looking to financially engineer returns. Our goal is to enhance returns without adding a whole lot of risk. Typically in normal markets, we're looking to maybe add another 100, 200 basis points of return by taking on a modest amount of leverage. We have 25% leverage in our portfolio right now. That's within our target range. Really, our focus with leverage over the course of the next couple of years is bringing down our cost of debt. Again, in terms of our debt composition, we've got roughly 50-50 between floating rate debt and fixed rate debt. We've actually got a couple property level floating rate loans that will be paid off this fall. That'll bring our cost of debt down as well as our leverage down a little bit, but we still have that capacity at our fund level to be able to draw on more debt if it becomes more accretive over the course of the next couple of years. In terms of non-core, which has been a big component of how, since I've worked in the fund, I've worked to structure the fund. Fundamentally, I have not been a big believer in buying stabilized assets at full retail pricing because the yields are too low. And so what I prefer to do with this fund is be able to go out and find ways to buy properties using non-core strategies such as either development or renovation or taking lease-up plays. And that basically allows us to be able to buy or to build these properties at higher yields than we could get if we were buying a fully stabilized property. And so I talk about that Smoky Hollow deal I was just talking about. That's a great example of that. And so, the question always comes up, how is that different than what you can do in a core plus fund? Frankly, these are the same type of investments that you could see in those types of funds, but because these are being done within the context of the core fund, you've got that downside protection of a lot of in-place income. We also typically don't do as much of those non-core investments. All Odyssey funds are capped at 20%. We typically do no more than 10 to 15%. We've actually pulled that back most recently because of where we are in the cycle. But you get exposure. You can get exposure to the exact same type of investments through our vehicle, but we think that we're doing it in a little bit more of a risk-mitigated way, particularly with less leverage in our portfolio. But it's a good way for us to build a portfolio and get to higher yields. And then JVs, I talked about before. We only bring in JV partners if there is really kind of a very specialized situation where we think they've got expertise. We control all major decisions, and once we kind of get to the value creation phase, we structure in our JV documents that we can buy them out of the deal. And so we basically own the property 100% at that point.
On the joint venture partners, what are the types of partners that you're working with? Are they REITs? Are they other funds, other strategies? Can you talk a little bit about the general profile of who's a partner there?
We work directly with operators. We typically don't partner up with REITs or other institutional investors because, frankly, there isn't room in the deal for that. And we also make sure that we have control. We look for people who are specialized skills. And so for our self-storage property, we went out and found a very strong self-storage developer that focuses specifically on California and Hawaii. And that's how we built our self-storage properties in the country, in those markets. And so we're going through it right now. Basically, at the point now we've stabilized that property. We're going to buy out that partner at some point this fall. In terms of what we've done in the Southeast with industrial, again, focusing on finding a Southeast-based industrial developer, building those properties, getting them leased up, buy them out when they're done. We've gotten through the valuation phase. So we're typically looking for operators, people who are at the ground level, who are local to a market, who've got that local expertise. That's what we look for. I talked about the next page about the income growth as well, so I'm going to skip over that in terms of, for the sake of time. I'll go down to page 21, which gets more into relative value, because I talked about kind of that cap rate comparison before, and I think this really is an important page, and I think certainly we focus a lot on this, and I think everyone should kind of be digging into this as well. And I know Aaron does a lot of work digging into this as well. But we think that our fund offers strong relative value where we're marked at right now. We're marked at a 4.7 cap rate. And again, looking at the index, it's not that big of a difference in terms of the top line number. But when you really kind of look at the sector by sector basis, you can see that we're basically in line with or slightly higher in most sectors. But the notable difference, though, is in life sciences and office. Our life sciences yield is about 200 basis points higher than our index. And again, as I mentioned before, we think people are basically keeping values high even though income is falling, and that's what happens there. We're not doing that with our portfolio. Again, life sciences isn't a huge part of the index, but that's not necessarily the case for office. Office is, still a decent component of the index, and so it is driving their yield lower than it should be because they're keeping cap rates so low as opposed to where stuff is actually trading at in the market right now. We think where we value our assets makes a lot more sense. Again, we only have 2 properties. They're better leased in the index. They're in better markets, I think, generally than what you'd say the average asset is for the index as well. And so we're carrying a higher cap rate and we're better occupied, I think is a strong case for where we're valued at and why we think that we offer much better relative value versus the index.
And, I'd like to jump in on the, just on the office transition that a couple years. And you showed some of that exposure on slide 17, the decrease from office. As I'm recalling, there was something like, I don't remember the number, 8 to 10 total office buildings.
That's correct.
Somewhere around there back in 2020. Now there's just 2. You've sold off a lot of those buildings since then, and part of that process is marking the values down in order to actually be able to make the sale at a market rate. I guess I just sort of want to remind the board of how big of a change that's been for this particular strategy since 2020.
Yeah, it's a very good point. When I came onto the fund back in, call it late 2017, early 2018, one of the big things that I worked with Deb, my former co-PM, on was that we fundamentally thought there was too much office concentration in the portfolio. And so there were a lot of kind of island suburban assets that didn't make a whole lot of sense. We focused those first few years on getting those out of the portfolio. And so we entered the pandemic, with roughly 7 office assets, and that includes the new one that we built, just at the beginning of the pandemic, which is the only one that we did together, frankly. And we basically felt pretty good about that defensive positioning. We lightened up our load a little bit in 2021 with one very big chunky asset that was located in South Florida that I'm so thankful that we got rid of. So that basically left us with 6 assets in the portfolio. One that we built that was completely new construction, 100% leased, 701 Rio. That's with the property in Austin, Texas that we did together. I love that asset. It's a perfect kind of post-COVID asset. But then looking at the rest of the portfolio, frankly, they're commodity office buildings. And I think it's important not to fall in love with these assets and think they're something that they're not. These are exactly the type of assets that have trouble attracting tenants. People aren't really motivated to come back to work at a property like that. Even though you've done all the bells and whistles, you've renovated your lobby, you've put in amenities, but still there's nothing that is going to draw someone in like a 701 Rio is. And so over the course of the last couple of years, particularly in light of where we saw interest rates going and where capital markets demand was for office, we marked them to market cap rates. We assigned realistic values to these assets. We didn't see our peers in the index necessarily do it as quickly as us, and we thought that was a risk, but we were willing to do it because it would allow us to basically get into this downturn, get through this downturn more quickly, and come out of it more quickly. And that's exactly what's happened. Our outperformance these last couple of years is directly related to the fact that we took the right approach to our evaluations. We took those assets out of the portfolio, we took that hit, and we reallocated to sectors that have more growth prospects, particularly retail and industrial. And that has yielded outperformance for us. And as I think about where the fund is going these next couple of years in terms of our performance projections, and I compare that to what we're hearing from our peers, I compare that to what we're hearing from the Pension Real Estate Association that does a quarterly survey of where they think returns will be at for funds like this. We are projecting returns far in excess of what people think is going to be achievable in the market. And again, it's because we lightened up on the stuff that we think is going to have the most downside over the course of the next couple of years. It wasn't easy, frankly.
We have one in the pipeline now in Seattle that attracts people.
So it's an interesting one, and it's kind of provocative that I put office on the pipeline because honestly, office is kind of a 4-letter word, even though it's 6 letters technically. But people aren't really looking to do office these days. But I think that what's happening right now is you're finding some assets that have got great bones to them that are located in those live-work play locations that people will come back to. And so that specific asset is a property that we know was leased by a large tech tenant back in 2015, fairly new construction on the property, so only 10 years old. Another manager thought they could convert it to life sciences back when life sciences was more in favor back in 2021, 2022. They ended up overpaying for the asset and now are trying to just get out of it. And so it's a property that's great bones that you can now buy at a significant discount to where it was trading at in the last cycle. And so that could be a potentially interesting lease-up play there. It's something that our acquisitions people have been kind of kicking around these last couple of years because you've seen the seller try to sell it at one price, not get that price, and it comes back a year later at a lower price. They don't get that price again, it keeps coming back. Now it's to the point now we're starting to come back at a price that seems a little more compelling. I'll be clear though, it's a very high bar to clear for me to do any office investment. Like I tell the acquisition people right now, unless you put your own money into it, don't even bother talking to me about doing this deal. So, but I wanted to put it on there because it's not that I'm redlining office, but it's going to be a really, really high bar to clear for me to do another office deal in the near term. Sure.
Then with the high-tech layoffs, how does that also affect your perspective?
It certainly, again, does, kind of make me a little more bearish on the sector. One of the biggest drivers of kind of office performance is office absorption and job growth. And if we're not seeing that job growth overall, particularly for those office-using kind of functions such as tech employment, that does make me more bearish on it. So again, I'm going to have to find a location where I actually am seeing job growth, where I am seeing people returning to the office to consider doing that office investment. There are a couple of nodes you see around the country where that's the case, but there aren't many of them, frankly. So we talked about valuations. I think the next page goes into sustainability, which I talked about before, so I won't belabor the point there. I will jump down to page 24 and 25, which talks more about performance. I kind of gave you kind of the overview of returns at the beginning. This page basically compares us versus our index. We are the dark blue bars in there. The index is the gray bars. Again, we've outperformed every quarter since the start of 2024. Over the last year, we've outperformed by about 200 basis points. That's top quartile. I think this page also demonstrates kind of our outperformance on income across multiple time periods. The other thing that's on this page, though, frankly, is kind of that 3 and 5 year relative performance. That does reflect our office write down. We took that hit on office before the index did, but that's allowed us to be able to come out of this downturn quicker than our peers in the index. And so every quarter that ticks by where we're outperforming, that gap starts to narrow. And so as I think about the forward projections for the fund, which we cover on the next page actually, this is what we're projecting for this year and next is well in excess of what I'm hearing from our peers in the index. It's certainly higher than what we're hearing from the consensus estimates. For 2025, we think that this fund will be somewhere between a 6.5% to an 8% total return. As we get into next year and beyond, we're going to be clipping off, somewhere in the range of 8 to 10% returns. I think what's important in this is that this is based, primarily on the income growth that's baked into the portfolio already. It's just leasing up our assets. It's marking our leases to market. It's doing some renovations in our apartment community. We've also got a couple of sales that are in progress where we know that we've got more value than what we're currently marking at. I think it's also important that we have assumed no cap rate compression here. We're not expecting that yields will come down. Although our expectation is, though, that if the Fed does start cutting rates, yields will start to come down. And if that's the case, we could meaningfully outperform these projections that are on the page. But this is my base case. We're not going to push beyond that right now. And so I think it's important as context for where we're going. And so if we're achieving these returns, we'll continue outperforming our index. And again, as we think about that 3 and 5 year track record, that's going to continue to look better on a relative basis. The next page, page 26, I like to put in there. I won't belabor the point, but since I've been on the fund, we kind of wanted to kind of look at what has been invested during the kind of the term of the current PM team versus what was legacy assets. This fund's been around since 2004, and so there are assets that are here that we didn't acquire, that I didn't acquire during my time, and so this really just looks at what has been bought since I've been running the fund versus what has been bought by other peers in the index. And generally, you're seeing that the assets that we invested in have outperformed on average by about 400 basis points. Again, I focused on using our non-core allocation to be able to bring new properties in. We focus on residential, industrial, and self-storage. I want to apologize for choosing the right sectors, but that's what we focused on. We think that's where we wanted to allocate capital, and that's what we've done. So it's done well for us. And so, really as we kind of get into page 28, is get to more kind of final takeaways, from what we talked about today. Really, I think that the fund is ideally positioned for where we're going right now. In terms of portfolio composition, we've got overweight allocations to the sectors that we think have the strongest prospects. We've got a clear underweight to office, which I do think is going to be mired for the next, probably 5 to 10 years or so. I think it's going to take a long time to kind of dig your way out of what's happening in office. In terms of where we're valued at right now, we think that we offer strong relative value. I talked about income growth. There's a lot of growth that's baked into the portfolio, particularly coming from our industrial portfolio as well. And again, we're a leader on sustainability. I think regardless of political climates, this is something that's very important. Certainly, our insurance companies respect what we've done there. It's helped us operationally, and so we continue to focus on that. From a performance standpoint, we're returning to our target range for a core fund much quicker than our peers in the index. The outperformance I've talked about these last couple, quarters has really kind of demonstrated that, outperforming every quarter since the beginning of last year. Strong performance on a trailing 1 year basis. We think that our forward returns are pretty attractive relative to what we're seeing in the index. Again, getting back to more normalcy. And again, it's based on income. It's not, just financially engineering with valuations. And then hopefully it's also come through that we're being disciplined about capital management. It's still a really challenging environment, frankly, right now, particularly with capital flows. But we're doing what we can to be able to continue to invest accretively into this portfolio, while also managing our leverage and also addressing our redemption queue, which we've done. It's been kind of a tightrope to walk, but I think that we're doing it with this portfolio. We've made recent investments in industrial in the markets that you want to be in. It's giving us growth in the portfolio. As we think about new contributions, as we get more capital in, we're putting that towards our target sectors. We're leaning in on that. And then in terms of dispositions, we're being really strategic about that. We think about properties that aren't really a fit from our portfolio, and we're identifying those first, and those are the first ones to go. And so if we're thinking about a property where the growth prospects aren't necessarily as strong on a go-forward basis, if we've created strong value there, we'll harvest that value. We'll use that to return capital to our investors. We'll post a nice return for doing that, and we'll also address our queue and manage our leverage down. And so we think we're being responsible about that. I'd also point out on the next page, I'd be remiss not to point out, in terms of that new capital, to the extent that you are thinking of allocating new capital, we are still running our 40 basis point management fee program. I understand from talking with Aaron and Callan that you guys you're thinking also about kind of reallocations, perhaps bringing in other managers, doing more on the core plus side too. If you are looking at doing more on the core side, this is something that's still available to you as well. This is a 40 basis point flat management fee. This is really accretive. We've had a lot of investors kind of take advantage of it over the course of the last year and a half. To put this in perspective, you typically have to be somewhere around a $500 million investor to be anywhere close to 40 basis points. And so if you're thinking about reallocating more capital, this is a great way to get in more exposure into the fund. And so I wanted to put that out before I wrapped up. So I'll pause here and see if there's any questions. I know I've thrown a bunch at you. I speed talked for the last 40 minutes. Please let me know if there's any questions.
Robert, can you go to 25? So when's the last time your fund achieved the 8 to 10 that you're forecasting next?
We were doing that just before COVID, and then in 2021 and 2022, we were actually into the 20% range. But okay. I put that aside because that's not typical for these funds. That was during kind of that coming out of the reopening period where you were starting to see that. But typically we're in that 8 to 10% range.
And why do you think that your fund is unique to expect that in the near future?
Well, from a composition standpoint, not having roughly 20% of our fund tied up in office assets, which are probably going to give you functionally a 0% return over the course of these next couple of years, that will help us in terms of our composition. But we've also leaned into those sectors that we think have a lot more growth prospects. The industrial that we're doing, again, just from having allocations there with our existing portfolio, our in-place leases are about 22% below market. And particularly as we get into 2027, some of our biggest industrial spaces in Dallas and Los Angeles will come up for renewal. We've got a lot of growth that's baked into those leases there. But then also the new stuff that we've done, we're leasing it up. That's going to bring a lot more income into the portfolio. And so we're finding ways to generate that growth. We're not, again, assuming that we're going to get a lot of pickup in terms of valuations from just cap rates coming down. Again, it's about operationally. It's just income growth that's driving a lot of that. And it has helped, though, that we have allocated to the sectors that we think have more growth prospects resi, industrial, retail, and again, not a whole lot on the office side.
And that seems to be a strategy when you guys reevaluated this property and ripped the Band-Aid off.
That's correct.
Just
That's
say,
correct.
We're not gonna try to smooth this over numerous quarters, numerous years, we're gonna rip the Band-Aid off, and then write these properties down. And
That's right.
remove. And is it your opinion, as you sit here today, that other people haven't done that?
I think that's the case. If you look at the drawdown, the Odyssey, for office has been roughly around 40%. When you're actually seeing where assets trade at that have been trading in the market, that save stuff that was bought in that kind of vintage of 2015 to 2018 or so, you're seeing that they're trading at 60% plus kind of discounts to where they were bought at. So I think there's still more downside risk in the index. I think, frankly, when you do something that's a little bit outside the box, like we did, you stick your head out. You're a little bit different from the index. You make yourself a target, unfortunately. But I think it's the right thing to do. And some people are playing it safe. We'll just go along with the cloud. We won't stick our head out. No one's going to notice us. Yeah, people will question your valuations, but as long as you're not sticking out that much, people are willing to let it go. But frankly, I think we can find better uses for your capital than just hanging out in office for the next several years, hoping that people come back to the office. Because the important thing about office, too, is that even if you just keep the assets, you don't get to keep them for free. You've lost occupancy, and now you want to get released. TIs for these office buildings now, like the cost to get people to come in and build out their space that you have to give them as an incentives, are north of $100 to $150 a square foot. That's a significant amount of capital just to get released. And on top of that, you've got a building that's getting older now. You've got to modernize your elevators. You've got to redo your lobby. This is millions of dollars you're pumping into these assets that aren't giving you a return on that. And so I fundamentally think that we can find better places to use capital than doing that right now. And that's what we're doing. We're putting our money into stuff that has growth.
So would it be your statement, as you sit here today, that Sarah's essentially ridden that wave
We have.
of what you've done,
That's correct.
and that it's smooth water ahead?
I think so. Yeah, I can't guarantee everything that's going to happen in the economy. Hopefully, don't have another trade war that pops up. I can't control that. But from a portfolio composition standpoint, I couldn't have looked at you, honestly, 3 years ago and said, "Hey, I'm not worried about what's happening here." Like, there's nothing in this portfolio right now that I'm really worried about. Like, my biggest headache right now is leasing up a 70,000 square foot space in Las Vegas and a 150,000 square feet space in Austin, Texas, in industrial. If that's my biggest problem right now, I think we're in a good spot, because I'm not worried about trying to lease up a 400,000 square foot office building. I don't have to do that anymore.
I think I used a sport analogy last time you were here and said, you're telling me the Oakland A's are going to beat Sacramento and they're going to win more games, but they're still the Oakland A's.
Yes, exactly.
So what you're telling me is you're comparing it more to the Expos moving to Washington, D.C. and not the D.C. Nationals. So they redefine it.
Redefine themselves, yes.
Okay.
We have pivoted this portfolio. This is fundamentally a different portfolio. I understand, the performance track record is going to stay with us, but where we're going reflects a different portfolio. I think we right-sized our allocations. We've set this fund up for success going forward. And it's not just me saying that, we can demonstrate the performance, we've done it. And I don't have any, I can be full-throated about saying this is where we're going, and I have great confidence that we're going to get there. Sure.
Given the tourist decline in Las Vegas, how is that impacting your strategy for Las Vegas?
It's interesting. It's not directly impacting us there, because really the vacancy that we've got at one industrial property there reflects basically a trade show, actually. That's one thing that's impacting us there, not necessarily the tourism aspect. I guess it's related. So, but that vacancy kind of came from that. They're just not seeing as much trade show activity. And so we're trying to backfill that space there too. The larger issue in Las Vegas is that there's just been a ton of new supply, and that's impacting folks. And so landlords are doing the smart thing. If they've got a tenant that's coming up for renewal, even though, hey, that tenant's paying 50 cents a square foot and market now is $1, they're doing everything they can to keep that tenant. And we're doing the same thing, frankly, too. There's a lot of upside that's embedded at our existing leases in Las Vegas, too. But we're going to do everything we can to bear hug our tenants, and so we're not going to let them go. And so you're just not seeing people moving, because the sticker shock of moving to a new space is going to be so much higher than what they're in place. And so the market's kind of paralyzed right now. People don't want to necessarily make a decision, and so that's causing some issues in terms of making a leasing decision there. And so it is having an impact there. The Austin is basically an example of Austin industrial has done well these last couple of years because Tesla's moved there and become a big operator in the market. It has not helped that the leader of that organization has gotten into a Twitter war with the president. And that's kind of put a bit of a pall over the market in terms of industrial leasing, particularly on our side of Austin, Texas. Fundamentally, though, our property is right on I-35. It's an important corridor, for trade coming up from Mexico as well. Although it hasn't benefited as much as I'd say as what you're seeing coming through El Paso, but it is on an important route. And in Austin and San Antonio greater metro area has had strong growth. And we have good confidence in that asset over time. It's just taking a long time for people to make decisions there. But those, in terms of industrial, that's our biggest problem, our biggest headache right now. And that's not, a huge thing for us to worry about in the portfolio. Because again, we haven't marked, our Austin asset up. And we're basically carrying it at the cost we acquired it at.
So you opened with talking about talking people out of the leaving queue.
Mm-hmm.
And how much success have you had in that?
Not as much as I'd like, but we're having more now that we're actually demonstrating that the performance is there.
Are you incentivizing people in any way?
I'm careful what I say about that. We've had conversations with our parent company about doing something along those lines. We are currently not running a program like that. We know that some of our peers in the index are offering incentives for people to come out of queues. I worry that creates shadow queues, frankly, because people still are looking to come out. They're just kind of waiting till the incentive burns off. It's something I'm considering, though, frankly, to kind of help out with optics.
So like with the 40 BPS for existing.
People are doing stuff like that, too.
Yeah.
With some funds are offering 30% discounts to come out of the queue, off their fees to kind of come out. But it's for a time period, and so we'll see how that weighs out. I think people are kind of making the bet that by the time those incentives burn off, the market's in a different spot, and people will be happy to just stay in. So it's something that we're candidly thinking about. I wouldn't put it out there right now, but it's something that we are thinking about doing.
Thank you.
Sure.
Are there any further questions?
Let me ask just one question here.
Of course.
Chris, you talked about kind of the fund size allowing you to be, more nimble than others, and I would agree with that. I think that's a valid point. You've shown that, you're not afraid to be sort of tactical in some ways. Some of the effects of that are, no Midwest exposure, which we talked about.
That's right.
Self-storage, concentrated in one asset in one market. Can you talk about how you kind of mitigate some of those risks of concentration in certain areas,
Sure.
just being a smaller fund and how you manage that?
Sure. As we think about, kind of the portfolio composition and not being overly concentrated in some areas, as we think about dispositions, that's one of the things that we start to think about. Say, for instance, we had a fairly strong concentration of industrial in Dallas, Texas. And we started lightening up there in some markets that we had a little more concern about, particularly south of DFW Airport. There was so much more supply there. And so we lightened up there and focused our portfolio in markets to the northeast and north of the city, particularly in Plano and Garland, which we think have stronger fundamentals long term. So we lightened up there to reduce the concentration, but still maintain exposure in that market because we do have a lot of conviction.
Chris,
long
talk
term.
towards the mic.
Oh, sorry about
Yeah,
that. Because we do have conviction long term about where that market is going. So we want to maintain exposure there, but we did lighten up a little bit there as well. Similar thing that we did in northern New Jersey. We have basically a number of industrial assets that are out there. But we looked at basically our portfolio and said, okay, where do we want to focus at though? Which assets in this market do we think have the best long-term prospects? And so we lighten up on assets where the forward income is a little bit lower and then lean into the assets that are stronger for us as well. And so it is something that we're mindful of. Frankly, as I think about kind of the next phase, I look at kind of our larger assets and I say, is this too much concentration in one particular location? We've been pretty, transparent in terms of our quarterly calls. We've got a fairly sizable retail asset in Sacramento. That's probably something that we take to market next year. I like the asset. We've owned it for 21 years. It was an original seed asset into this portfolio. I think for our fund, though, having such a large asset in Sacramento is probably not the best allocation for us, though, even though it does, fairly well for us, though.
Arden Mall?
Not Arden Mall. It is a retail asset located in Roseville. And so it's been a great performer for us. But as we think about kind of the depth of the market from a capital market standpoint, not necessarily tenants, it's a question of who am I selling to at the end of the day. We look at the NPI, and we say, really there's maybe 2 or 3 other NPI retail assets in this market. Most of what we've seen from institutions like ourselves has been on the residential side, maybe a little bit industrial. And so you're just always worried about, at some point you're going to want to sell this investment. Who am I selling to? I can't have too large of an investment in this market. And so that's one thing that we think about though too. But to your point though, it's top of mind for us, because for a fund of our size, we have to be focused on it. We can't just take a scattershot approach and say it'll sort itself out. We have to be very attentive about this and make sure that we don't get overexposed in any one location. For the Midwest point though too, I would point out though, our target for Midwest is 0 to 5%. If I found like particularly a good retail asset in a strong trade area, I'm pretty much market agnostic in terms of retail. If it's a strong trade area, I'll do the deal. We're seeing opportunities around suburban Chicago that we think are interesting for retail. I'd also consider self-storage there, but it's really tough to get into that market in terms of building new product there, which is why, oddly enough, self-storage around Chicago has done very, very well. So,
Do you have any single-family residence in your portfolio?
we do not. It's a sector that we've looked at. If we were to rewind 3 years or so ago, it'd be a sector we talked about quite a bit, but we frankly didn't have a lot of exposure in our platform. That's not the case today now. We do have exposure in our platform. A couple of our accounts are investing in that. Frankly, we've let a couple other accounts get educated on the pluses and minuses of the sector. It's something that we would look to do. We wouldn't kind of take that scattershot approach of buying individual houses. Frankly, we don't want to be competing with people trying to get a first home. That's just fundamentally not what I want to do. But if it was something that was purpose-built, we were building new product where we could build a critical mass of units somewhere, we would consider doing that. But we don't have it in the portfolio right now.
Okay.
I see Claire has a question.
How do you think about the exit queue and potentially a less favorable outcome with the exit queue in the context of the forecast that you?
Sure. So our queue right now is $443 million. We have in our capital plan for next year several transactions that will basically clear that queue by the middle of the year. It's assets, like I just mentioned, the property that's in Sacramento. It's on the office side as well. We've got very strong indications that at least one of our office assets at our mark will easily clear. And we've got a couple other properties that are slated for the back half of the year that are more for just normal course. We've reached the end of the investment period for those assets. And so as I think about downside necessarily for exit queue, I'm not really seeing it in terms of being able to clear it. Really, kind of the big thing I'm worried about is overreacting to it. I don't want to sell something that I think has long-term prospects. And so we did a lot this year, and it's burned out in our numbers to get our queue down significantly. I've got a couple more that are going to close this fall that'll make another sizable bet. And I think we want to be very judicious, particularly at the beginning of next year, about not paying out too quickly or too much, because I just don't want to overreact to what's there. Hopefully that answers your question. It's a good question, and I think it's something that's really important for us to consider on that. But in terms of executing and the transactions that are baked in for us to clear our queue, I don't have any concern, right? So we've got everything marked at the right values. Sorry, I gotta keep looking this way.
Yeah,
My apologies.
We can hear you.
Okay, I believe that concludes this presentation on time.
It's about an hour. Yeah.
Okay.
Great.
So what we're going to do is we're going to take a short break at this time, and then when we come back, we'll hear from Principal Real Estate Investors. Principal. And let's see, let's come back at 10 minutes after 10. Am I reading that right?
Thank you.
Thank you so much. And
Doris.
again, if there's any more questions.
You ready?
One moment.
Let's make sure
There we
that Trustee
go.
Kelly can.
Let's check our participants. They should be here. So we have James Lang.
Oh, we have actual
Got some hard
Everybody's
copies.
still
actual
there.
board here.
Thank you. Thank you.
Oh, excellent. Thank you so much.
Is this the same as the
Should be the
tool?
same, yeah.
Okay.
Yeah.
Is it the same as it was?
It is.
Okay, good, thank you.
Okay, let's bring this meeting back to order. Right now, we're on item 2, investment matters. 2C, principal real estate investors. And I believe we have Darren Cleese and James Lang making a presentation.
Yes, good morning. Thank you to the board and Callan and Robert for inviting Principal Real Estate in to discuss Mendocino County Employees Retirement Association and the core real estate allocation. Joining us today, Darren Cleese, portfolio. Darren has been with the firm since 1992 and a member of the portfolio management team since 2007. If you have a copy of the presentation, I'll go ahead and flip forward. There is an overview of the portfolio management team on slide 9. You'll see this is a tenured and experienced team of portfolio managers. Also, James Lang, relationship manager with Principal, worked with clients on the West Coast in Canada, but been with the firm since 2007. Should we earn your trust in managing your core real estate allocation, I would be your dedicated contact and relationship manager. Okay. Just, I'll flip back here. Just a quick overview of Principal Asset Management, headquartered in Des Moines, Iowa. Just about $580 billion in assets under management firm-wide. That's across all asset classes. Our discussion today, Principal Real Estate, is highlighted on slide 4, and you'll see that we are a top 10 global real estate manager with over $100 billion in real estate assets under management. Our platform draws from over 60 years of real estate experience, and that has developed into a 4-quadrant or 360-degree view of commercial real estate with capabilities across private equity, private debt, public equity, and public debt. For our discussion today, it's the top left box, the blue box, private equity, where we have capabilities across core all the way out to opportunistic, 51.7 billion in assets there, and the principal U.S. property account is our flagship core strategy. From here, I will go ahead and turn it to Darren for an introduction to the portfolio.
Thanks, James. Now, we've got a couple slides starting on slide 4 there that just kind of highlight some of our efforts around sustainable investing and some efforts that we've taken in that area. I think we've got a wide variety among our investor base regarding ESG investing and sustainable investing, but we've got investors in the fund such as the state of New York, where it's very important to, and states like Florida, where it can't be even part of the investment decision. So, and I think both sets of investors, including everyone in the middle, has been very happy with our efforts there. No one complains about saving money on a lot of those things, and reduced energy consumption and water consumption. And so we do all of that with an eye toward a fiduciary duty to our investors. And everything we do is, we look at paybacks on all that kind of stuff. We don't have a dual mandate in that perspective. All of our efforts go to enhancing the value of the real estate. But we've been recognized along the way for a lot of the milestones and things that we've been able to achieve in that area. Turning to slide 7, just kind of highlights, as James mentioned, there are a little high-level view of the fund. As James mentioned, this is our largest core equity offering for the fund. It's our flagship fund. Principal itself is one of the 10 largest investors in real estate globally, and this is our flagship fund across the organization. If you're not familiar with Principal, it's a large retirement services organization. We're the largest 401k provider, among other things, in the retirement space. So it's primarily a retirement company, and so we're very clear and a very prominent positioning of the real estate as an asset class within the overall retirement strategy. And so we fit nicely within comprehensive retirement strategy, and we're very clear about our core mandate as well. So very low risk, very used to managing pension assets and dealing with pension plans, our own as well as outside money as well. Couple other pages here just providing a little bit more detail of the account, and just as a reminder, we're investing in properties here. We're not buying stock in other real estate companies. We're not loaning money to other real estate people that own real estate. We're not buying bonds backed by real estate. We're buying the properties. We're in the landlord business here. We're looking for properties that good real estate that we think will grow, that rents will grow on over time and attract tenants. So that's just a reminder what we're actually investing in here. So it's a core diversified portfolio, core being a couple ways you can distinguish core funds from core plus funds is just generally a lower operating profile and risk profile for the investments with a core fund, so less debt. Debt is great. It magnifies returns when things are great, but it also magnifies returns when things are pulling back a little bit in the economy or there's a shock in the economy as well as at the property level, a little more of a core profile, so better leased, higher quality stuff. Core plus opportunistic, you're taking a little bit more intentional risk. And while we're not afraid to take risk for high conviction strategies and high conviction properties, we're very clear about our core mandate, and it's a low risk, very, very appropriate, we think, for pension plans. We are benchmarked against the NFI Odyssey, or we'll refer to the benchmark or Odyssey, kind of how we compare to the Odyssey right there, but we're very focused on outperforming. Got a good track record of outperforming that benchmark, so we're delivering our investors better than market returns for the same kind of strategy. And we've been doing this in this fund for over 43 years. And so principal, at the onset of 401k plans, designated this account, that's why we're called an account. It was just an account of the life company at the time that we started investing in properties back in 1982. And so long track record of doing this. I think we're the second oldest or longest track record out there. Principal's got a kind of a history of very, very long tenured people. I'm probably a perfect example of that. I've been working on this fund or the assets of this fund for over 30 years. And so at Principal's, it's a great place to do what we do in this space. And we're based in Des Moines, Iowa. We don't have any investments there. We don't have a hometown bias of investing in stuff that we see regularly, so we're able to take a real clear-eyed view of markets around the country and study things very objectively. We don't have a lot of times in our business, we see a lot of real estate investors, invest heavily in markets that they live in or that they know well. You might see a Chicago-based manager invest in Chicago, a Boston-based manager have an overweight to Boston or New York. We don't have anything client money invested in Des Moines, Iowa. We're able to take a more objective view of all of the markets around the country. Highlights of the team that we're supported by. We've got a 5-person team dedicated to this fund, in addition to a number of research professionals, asset managers, acquisition managers, debt professionals. But we've got a 5-person team that's dedicated, and you see a pretty long tenured team as well. I've been over 30 years. Kyle's been in the business for 26 years, 14 years at Principal, and Bridget, also in the fund, she's been with the firm and the fund for 19 years. So very long tenured. As I said, it's a good place to do what we do and invest in real estate. Drilling down a little bit into the fund on slide 10 here, gives you a few high-level snapshots of where the fund sat at the end of the second quarter. We're just over $10 billion in assets, and that's comprised of a little over $2.5 billion of debt and then $7.5 million of investor capital. That's kind of the difference between the net and the gross asset values there. 126 properties really spread throughout the country, and as you'd expect from a core strategy, as I mentioned, lower leverage is one of the things that differentiates core funds. 26.7% of the fund is levered. Its debt as I mentioned, is great when things are moving up, but they can magnify things on the downturn as well. And so we're slightly underweight for our debt. As you'd expect from a core portfolio, a little over 90% occupancy, which is good. We've got some room to do some additional leasing on the margin. In fact, we just signed a lease last week in Ontario, California for 900,000 square feet. So we're having good success leasing across the portfolio, and so that'll bump our 1 year, what we call net absorption or space lease that was not leased a year ago. That'll bump that up to over 1 million square feet this year. So occupancy will increase, but we've just got a couple of those large needle movers that will improve occupancy. And finally, just update on investor cash flow. You may have heard a lot about queues in this business, money that wants to get in or get out of some of these funds that invest with the same strategy we do. We don't have a contribution queue. We did. In fact, in 2022, we had over $500 million contribution queue. And when we saw the market start to change and interest rates go up, we actually didn't call that capital. We told those investors that were in that inbound queue, hey, interest rates have moved up. There's some things changing in the market that we don't think it's a good idea for you guys to fund your investment. And that was in the middle of 22 when interest rates started to go up. And so we didn't call any capital and really didn't market this fund for over 2 years. And just because the last thing we want to do is call capital only to write it down. And so that was a different approach taken by some of the other funds that saw inflows at that time. They took capital in only to write it down and maybe pay out some other investors that wanted to get out of the fund to avoid some write downs or the effects of higher interest rates. As a fiduciary for our investors, we didn't do that. We didn't call capital. Last thing we wanted to do is call that capital and write it down. And so I think that's one example of the principles, our parent company and kind of the overriding ethics of the company in how we treat investors along the way. So we don't have a contribution queue. We've called all that capital. When we started calling capital last year, the middle of last year, when we saw kind of the bottom was in for core real estate funds, the bottom was in for our net asset value, and so we started calling capital last year at the bottom of the market. It's not like real estate's a little bit different than the stock market. We don't have a perfect crystal ball, but we've got better visibility into what might happen and where we are in the real estate cycle. And so we felt pretty confident that and had conviction that the bottom of the market was in last year, and we thought that was a good time to start calling that capital for new investors. That was a good entry point for funds like this. Our redemption queue, we were one of the first 3 or 4 funds to pay out all of our investors that wanted money out from this, in the 43-year track record of this existence of this fund. We've had a withdrawal queue 3 times, one for the global financial crisis, one brief one during COVID, and then this what we call the Great Tightening as well. And so other than that, we've had daily liquidity for this fund, which is better liquidity than you get for just owning real estate, commercial office building or a commercial shopping center or something like that. So we've got better liquidity. Now, we don't have daily liquidity for our outbound queue as well, but we did pay all of our investors that were impacted by that queue out in the first quarter of this year. We actually announced another $100 million payment to investors last Friday. And going forward, we'll have more of a balanced approach of returning capital to investors that want their money, that need some money right now, as well as buying properties at what we think is a great point in the cycle coming out of this downturn that we've seen over the past couple of years. So we're going to have a balanced approach, but it feels good to have that queue behind us. We sold over $1 billion last year of properties and sold them at attractive prices. And we're able to pay out our investors and be one of the best or first funds to satisfy all redemption requests. So we're truly back on offense. We're not dealing with a queue anymore, which is great. It feels great to be looking at new deals again, especially at some reset pricing that's out there in the market today.
So Darren, I actually have a question,
Yeah.
and I sort of want to skip ahead. Page 30 of the deck, redemptions. Now, we're talking about our investment, maybe $30, $35, $40 million. We certainly wouldn't need to take all of that out
Yep.
at any given time. But the way I read this, that says daily redemption subject to this limit that's much higher than something that we would need. Am I to actually understand that if we had a $30 or $30 million balance with you, if we needed to pull 5 out, we could do that essentially daily?
That's exactly right. Yeah. And as I said, we don't have that today, but that's what we've had in the vast majority, in the 90% of the 43 years that we've had this fund. That's been the kind of liquidity that we've had in the fund.
Okay, so slide 30 is incorrect.
It says in the absence of a withdrawal limitation, clients and right now we have a withdrawal limitation. So,
Gotcha.
yeah, we paid off the queue, and in previous times when we paid off the queue, we've gone back to daily liquidity. We haven't done that yet just because so many other funds are still dealing with large queues. And a lot of investors, if they want cash, they go to the bank that's open, and maybe the line is shortest at right now. And what we don't want to see is unintended consequences of a run on the bank, if you will.
Gotcha.
And so we'll continue to provide, I think, better liquidity than the market, but we're very much looking forward to a period where other funds get on top of their liquidity and we can go back to daily liquidity. We anticipate doing that, hopefully very soon.
Yeah, that's quite interesting. Just for
Which
the
is very
board.
different, yeah.
I would note that that's sort of a unique option here.
Lenore?
How long did it take you to eliminate the queue?
Just over 2.5 years. We put it in place on July 1 of 22, and we paid it out in February 25th of this year. So just over 2.5 years. And we did it through we didn't borrow additional money to do that, incremental money to do that. We sold properties. We sold, our queue peaked in 24, about $1.4 billion, and then we started making payments. We sold over $1 billion last year and sold some things early this year as well. So, and if you've got your assets marked at market, it should be no problem to do that. If you're realistic about your values, but if you can't sell at your values, then you can't do that.
You mentioned, of course, a hometown exclusion. How extensive or geographically extensive is that for Iowa?
We don't have an exclusion, but we generally invest in markets that are over 1 million people. And so our capital of Iowa, the biggest city where I live, is 250,000 or so. So we would not invest where we're a large employer in Des Moines. We wouldn't do something if we did, merged with a company and laid off people in Des Moines or something like that. I don't know. It would impact investor capital. That's the last thing we want to do, is make a business decision that might be in the best interest of our shareholders that would impact client investments. So that's a reason. And while the stuff we do every day, Des Moines is a great place to live. It's not one of the fastest. The way we evaluate markets, it's not one of the fastest growing in population and employment, and that's really what we favor, being in those invested in those markets. So on slide 10, just wrapping up there, we've got one of our properties there pictured is a data center property that we've got in South Florida. It's leased to one of the major cell phone providers. Great asset, fortress-like asset, obviously, as you expect from a cell phone company in South Florida. It's their data hub for South Florida there, but needs to be hurricane resistant, very resilient property in South Florida, and in a space that's very interesting to us, which is the data center space. A couple things that are resonating with current investors and prospective investors like yourselves. Obviously long-term outperformance is the number one thing that people want to see, and we've got income and total return outperformance better than market returns over all time periods. And we've done that by really growing our income, or if we were a public company or so, we'd be growing our earnings. And so we're growing our income and getting more of our return from income. And we've got a slide with our growth of our income a little further back, but very, very strong. We always thought interest rates would go up. We kind of missed the mark on how fast they would go up and by how much. but we always constructed this portfolio with an eye toward interest rates going up, and we always thought we'd outrun the impacts of higher rates through growing our income. And so that's proven to be very successful strategy for the fund. We've got a very strong research area that helps inform our investment decisions. They've really helped us get some of the calls right about underweighting office and, in fact, in the mid 2015s or whatever, underweighting retail when retail was under stress from e-commerce, as well as overweighting the right sectors as well. We're very hands-on real estate investors. We just don't buy it and property and collect the rents. We're very actively involved in leasing decisions and managing the expense side of things, everything from renegotiating insurance. We just saw a 14% reduction in our insurance rates at a time where not many investors or property owners are seeing that. And that goes right to the bottom line for a lot of these properties. And the last thing is just being a core real estate strategy. We're not overly reliant on banks and having to refinance a loan or anything. And we've been very successful in navigating the high cost of interest rates out there right now. So, slide 12, a couple of the investment themes that have kind of informed on our investments that we've made in the portfolio. I talked about income a little bit, good relative value investing, as well as a couple demographic trends that we're paying attention to and has informed our investing, such as, it's no secret the baby boomers are, and kind of that demographically themed investing is something we're very focused on. The retiring of the baby boomers and the growing need for age-restricted or senior housing of some form or another, as well as you see a kind of a drop-off in the college-age students, or the number of people in the U.S. that are turning 18 years old right now, or college age. So that's informing some of our decisions on student housing, causing us to stay up in quality at student housing. There may be a little bit just with fewer people turning 18 and college age, and even maybe fewer of them even going to college than ever before. That's something we're monitoring as well. We got a good research department that does that. As far as how that translates into strategy for the fund, on slide 13 there, we talked about relative value, but we pay just as much side as the liability side of our balance sheet as we do to the asset side and the properties. And so we're very, very disciplined there. I talked about driving operations at the property level, ways we can add value and is improve our income, lease more space, negotiate higher rents from our tenant, as well as manage our expenses. And then finally, on the right side of slide 13 is our diversification. As you can see, as you'd expect from a fund like this, the vast majority of the fund is going to be invested in high quality, stabilized properties. But we do have a couple areas where we can take a little bit more intentionally higher risk, such as buying a building with some leasing risk, or development. We've got 2 developments in the fund going on right now. One is in Austin, Texas, where we just signed a lease with Tesla for 270,000 square feet before the building was even completed, as well as a property in Los Angeles on Sunset Boulevard on the west side of Los Angeles. So apartment property that we expect to be completed in the next few months as well.
Question?
Yeah.
I used to live on Sunset Boulevard.
Okay.
Corner of PCH. I don't think it's there anymore. This is a situation.
Yeah.
Was fire on.
That's right. Yeah. We're in Echo Park, so just west of downtown, kind of Silver Lake, yeah. Echo Park area. So a very a lot of people that work in the entertainment business. It's a little more. It's not the Pacific Palisades and closer in there to the or Malibu. We were not impacted by the fires. If anything, the fires have probably created more apartment demand. So we're in a hurry to get. We're actually having trouble getting some inspections just because the county is backlogged with a lot of fire rebuild stuff, and so we're trying to get our apartments completed quickly. And inspected. So as soon as we get that completed and done, we'll be leasing units there in a good market. So, but it's well located property. But yeah, on the west side. So not on the far west side though. Slide 14 just gives you a sense of where we're invested across the country. Yeah.
We have a question.
I even hate to use the buzzword, given I had my university master's in statistics, but to what extent does your operation sort of rely on AI?
We've been using AI in our investment process, but we've also been investing in data centers, which are heavily, benefiting, and we've seen some of our best performance across our whole portfolio have been data center properties that are meeting that demand for data center companies. So a couple ways it's impacted, but yeah, we have been using it to forecast rent growth in markets is one, help with identifying markets that will be the best opportunities for rent growth is probably the most actionable place we've been using it. There's just a lot of data out there, and AI has really helped us pull that all together for all these markets and roll them up. It could take months if you just did that with research analysts, but you can do it, as you know, very quickly, and there's just a lot of data. And so we've always been very data. We consume a lot of data, we buy a lot of data, we have a lot of internally generated data, and AI has really helped us inform, especially when we've got the whole country to invest as an investable universe. But yeah, we've got, I think, 14 data scientists dedicated to AI within our investment group, and so the company overall has made a big decision, and our investment decisions are benefiting from that.
Or research analysts.
Right now, there's just a lot of people we haven't gone to fewer people. We've just, so it hasn't really eliminated any jobs yet, or I don't know if it ever will, but I think it's made our investing process better though. So yeah, slide 14, again, probably shows the outcome of some of that research that we've done and kind of aggregating a lot of the data that's out there as far as population and employment growth, and obviously seen a lot of changes over the past few years in population and employment growth. And you see the markets that we're overweight to and where we're underweight to, and you see that has really informed on the right side, the lower right side of that page, it just shows you the investment performance in those different markets. So being able to pick the right markets and right areas of the country has really enhanced our investment performance as well, because we've seen better performance to those areas that we're overweight to.
Question.
Yeah. Could you more definitively define the areas of the blue circles for California?
Yeah, so we've the blue circles are where markets were overweight relative to the benchmark. And so as you can see, we're underweight to the Bay Area. I would probably prefer to be underweight to even some Southern California markets as well. Some very high quality assets that are performing very well in Southern California. It gets me a little more comfortable with that overweight. But in the Bay Area, you can see we're underweight. We don't have anything in the city of San Francisco. I don't think we've had anything in the city of San Francisco for over 10 years. We used to own a couple office buildings down there, 333 Market, 150 Spear. We sold out of, the city of San Francisco pre-COVID even. And so, it says Oakland, our assets, it encompasses everything from Pleasanton to Berkeley. We've got some student housing at UC Berkeley. That gets lumped in with that Oakland market as well. We've got some industrial at the Port of Oakland. We do have an office building in Oakland, but also an office building in Pleasanton as well that we're looking to sell.
But that blue circle, is it Riverside?
Yeah, the blue circles are Anaheim, which is Orange County. We have a large project in Orange County, a mixed-use project. It's actually at Jamboree and the 405. So it's Irvine. We own a property called Park Place. It's just one exit from the Orange County Airport. So if you've ever flown in and out of Orange County, we've got a retail center as well as a mixed-use office there. We've got Panasonic is our largest, Western Digital. It's a great, very high-quality property there, very well located. It's probably benefiting from some of the difficulties in LA, but that's really our overweight. We own some other things there as well, and it says Anaheim, but it's really Irvine. In Riverside, we own a number of large warehouses out in the Inland Empire. So Ontario, around the March Air Force Base in Inland Empire. So large warehouses, port-driven, and actually it's probably it's an overweight we have. Long-term, we like it, but right now it's really soft. Just fewer goods, global trade uncertainty, rents are down significantly. All that's priced into the net asset value of the fund that you'd be coming into, but very challenging. I mean, it was good for so long, and that's why we think it'll be good long-term, but right now it's very difficult. Not many tenants out there, rents are down. As I mentioned, that lease that we signed, 900,000 square feet, we just signed last week in a building that we own just east of the Ontario airport. So very high quality building, good market long-term. It's just challenging today. So, yeah. So, tariffs, global trade, there's just fewer goods coming through the Port of LA and Long Beach right now. We think that'll change, but at least that's what it is right now. It's a lot of, what's that?
We hope.
Yeah, a lot of users are shifting manufacturing to other countries, Vietnam, other countries like that. So we think it's probably a temporary softness there. So we like it long term, but it's a market that actually we sold 2 buildings. One was leased to Nike. Nike brought a lot of their products in, make it outside the U.S., brought it into our building, and then broke it down, and shipped it all throughout the country. So we actually sold that building in the second quarter of last year. That was part of the $1 billion that we sold. So we did lighten up our exposure in that market last year, and that helped us. Again, when we pruned the portfolio last year and sold that $1 billion, we looked at kind of the buildings, maybe the lower quality or older buildings that were maybe less functional. And while we sold that building, we leased it to Nike. We just renewed them at a very high rent, and we the next day after we renewed them, we put it on the market for sale. So, but that contributed to that $1 billion that we sold. We didn't want to sell vacancy. We were confident we'd be able to lease, some other holdings in that market, and we did. It maybe took us a little longer to the building we just leased last week. It was leased to Newell Rubbermaid. They had like Coleman campfire camp stoves and that kind of stuff in the building, and Rubbermaid products. And so they moved out last year, and it actually took us a year to get it released, but it's good building. We never thought it would take a year to lease that building, but it did. Yeah.
So
Sorry.
Trustee Swope, on the next slide, you could use a combination of the next slide, which shows the sector by region diversification, which is a slide I specifically asked for, right? So we can kind of get a sense of this. But also on pages 50 to 56, there's a listing of the properties. So, if you had a little extra spare time, you could go ahead and dig through all that, and, you could probably rip the presentation, dump it into Excel, do a little pivot tables, kind of see what's going on there if you really wanted to get into it.
I would recommend using AI for that particular.
Yeah, slide 15, as Robert said, is a slide he asked about last week, and I think we thought it was interesting, and I think it'll probably be part of our presentation book going forward, but just shows kind of, in what the different region of the country, what are we invested in, and what do we find most interesting. So that's included on slide 15. Talking a little bit, I'll pick up the pace a little bit here, but slide 16 just starts talking about the different property sectors or property types that we're invested in. Industrial is something, it's a little... In certain parts of the country, it's a little soft right now, but long-term, we're still very constructive on industrial. It's a low capital investment, and generally mostly dealing with some oversupply right now. But as I mentioned, difficulties in some port markets. We're seeing very broad-based demand, like this property here in Orlando. It's between the airport and the theme parks in Orlando. Very strong demand. I mean, a couple of years ago, rents were $6, $7 there, and today they're $16 a square foot. And so very strong demand for well-located infill properties that are, in port markets like LA and Long Beach, as well as Seattle and Tacoma are maybe a little bit soft, and rents are down there. Again, all of that's priced into the portfolio with that daily liquidity that I talked about that we offer for investors. We have daily pricing, and so all of the information that we have about the value of the property gets fed to our valuation consultant, and they value the portfolio every day. But again, rents in industrial are still pretty good in some of that, what we call last mile or smaller bay product in some of these markets that have, especially those large population centers, and we've got an overweight to those. Another sector that we think is good long-term is residential, and it's really hard to say there's a typical residential deal for our portfolio. We show the kind of residential that we're in at the bottom of slide 17. We've got a few, luxury Class A properties that are, maybe high rent properties. We've also got a lot of affordable housing in the portfolio, very high quality affordable housing that people that are making 80% of the AMI can afford to live in. We've got manufactured housing, and this has really been the best part of our residential portfolio is manufactured housing. And think second home retirement places in Phoenix or Sarasota, Florida, or stuff like that is kind of what our manufactured housing is. We've got couple student housing properties. I mentioned the one in Berkeley, but UC Santa Barbara, Duke University, University of Texas in Austin. But we've actually sold a few student properties at some of those universities that might be a little bit marginal, that I talked about might be impacted by that cliff of people turning 18. Yeah.
Can you expand a little bit on what manufactured housing is? Is that you're owning trailer parks? Is that that type of an investment, or are you?
That's exactly right. Yeah. Turn to slide 21. We've got a picture of one of our properties there, and this is called Rincon East and West, as we call it. Again, you can go look on the website here. It's park model homes. It's a lot of people, snowbirds from the Midwest and Canada that want a place to live in the worst worst weather in the Midwest and Canada, and so they come to Arizona. It's kind of a ghost town a little bit in the summer, but they pay rent on their spot for 12 months out of the year. And it's very high quality. These are age restricted, so you have to be 55 and older, so it's not the lowest form of affordable housing. But it's been a great investment. Our best, we're just passing through at this property here, we're just passing through in October a 10% rent increase. 10% seems like a lot, but for people paying $500 a month for a space, it's $50, and given how much rent on other places and other kind of housing has gone up over the past few years, it still lags well below and very affordable compared to other types of housing. And so, we're not just passing through large rent increases, we're also investing in the properties as well. So, but it's very low capital intensive. I mean, you can add a bathroom next to the pickleball court, so someone doesn't have to run back to their trailer to go to the bathroom in the middle of a pickleball match, and people will gladly pay an extra $50 a month. It's a fantastic business, and they're not making a lot of that. This new product, there's virtually no new supply in this manufactured housing.
How many actually single-family units do you think?
We've got about just under 300 units of single-family rental. And it's a combination, as I mentioned there, the property mentioned there is Everstead at Windrose. It's just north of Houston, just outside of an area called the Woodlands.
So is it a subdivision or is it a complex?
We've got a little of both. We've got what we call disparate or scattered site single-family rental. We have a little bit of that, but it's done okay, but not great. It's not done as well as manufactured housing or traditional apartment investing even. So we've paused new investments in that space. It's like I said, it's done okay. They're all full. But this property here pictured is a community where we've got shared amenities, where you can get your own home, but you have access to a pool, maybe a fitness center, apartment type amenities, but you have your own home where you can have your pet can be outside, or your kids can have a backyard to play in. This property here is got a sidewalk we're right next to an elementary school, and your kids can go to and from elementary school. So we see strong demand there. Again, it's been okay, not great. SFR is what it's called, but it's been okay. We're glad we tried it, but we probably wouldn't allocate additional dollars to it.
Darren, is that true for scattered site and build for rent?
Yeah, it is. We probably wouldn't add additional money to it, but so it's been okay, Aaron, but not great.
Yeah, we don't need to respect Callan in
No.
that sense.
So we like what we have. We're not looking to sell what we have right now, but we like having a variety of residential housing in the portfolio, but it's not where we probably see the best rent growth going forward. Manufactured housing, traditional apartments actually that are pricing below what it costs to build a new complex seems far more compelling than buying houses. But the single-family rental that we've got, the scattered site has been like a Pulte or a Lennar has, they maybe want to sell the last 6 in a subdivision so they can close their model and close out of it a subdivision. And so we've bought those homes at 20 to 30% below retail pricing. So it was a compelling investment, we think, at good, attractive pricing. But we haven't seen a lot of rent growth from it either. So we're all about kind of something where we think we can grow rent going forward.
So in terms of the residential niche subsectors, what sector are you favoring the most right now?
I'd say traditional apartments where you can buy below replacement costs. So I mean, anything housing is very interest rate sensitive. And so that's been impacted probably most by the higher interest rate environment that we're in right now, to the point where it's, new construction largely doesn't pencil today. There's new supply being delivered in a lot of markets that we think will probably be good longer term, but today they're slow to lease up, and we think they'll be good long term. So we'd love to buy a very high quality apartment deal that might be in a market that we like long term, but is just maybe stress in the capital stack. Maybe they're paying more in interest than they thought when they initially committed to that deal. So there's stress in the capital stack of a deal. Nothing wrong with the real estate, but just stress in the capital stack. So traditional apartments, if we can buy below replacement cost, as well as some of that housing that caters to seniors. So whether it be senior living, independent living, assisted living, or where we've been really successful in the, other than manufactured housing, the best part of our residential portfolio is what we call age-restricted housing. So we don't offer any services, but it's a differentiated product that really caters to people that have lived in a home. So slide 28 shows one of our properties there. It's just outside of downtown Denver. It's called Vita Littleton, and you can go on the website and look at this. I mean, this is a fantastic property, but it's a great example of an age-restricted. It caters to people 55 and older, but the average age here is 73. And so it's all people that have maybe they lost a spouse, or they maybe aged out of their neighborhood and wanted to sell their home. So we own in markets that have been very strong single family housing markets. Denver, Salt Lake City, Austin, Texas. But these units are built different than just traditional apartments. So someone who's 73 doesn't want to live next to someone that's in their 20s, got their first job in Denver and just moved to Denver. So these units are different. They might have a laundry room instead of just a stackable washer and dryer. They've got a mud room. They live around people that are kind of at the same stage of life as them. They have activities. And so it's a very high quality property. The units are built for people that are used to living in homes, not getting their first apartment and maybe don't use the kitchen.
Are they, is each one of these units something that has stairs in it, or are they?
There's no stairs. It's an elevator building, covered parking, shared amenities. It's right by the light rail. There's a light rail track. You don't really see it. It's just on the other side of the property here, on the kind of top of the property. That goes right to downtown. Goes right to downtown Denver. We've got a waiting list for this property. So if you want to live there, there's a waiting list for
We could use one of those in Utah.
Yeah, but
The light rail, yeah.
While we're talking about your different exposures, how do you feel about your 14% in office?
Yeah, the office that we have, at one point, we were 47% office in this fund. So back in 2015, we were 47% office, and that was when office was very accretive to, I mean, it was great. The more office you had, it was the best performing property type. It was great. It helped you. Most of that office we sold pre-COVID. So we went down from 47 to under 15 today. So we've sold over $3 billion worth of office, and most of that was sold pre-COVID. So the office that we have in the fund is very high quality, and I think is actually working pretty well. We've got our largest office building is, go ahead.
So you're going to stay at 14% relative? I mean, you're not looking to expand or to shrink that particular, buy properties or sell properties?
We'll probably grow our way. We'll probably see our allocation go down, but mainly because we're going to grow in other areas. So I would, a year from now, I would expect it to be less than it is today, but we've got some very high quality properties, and probably the fundamentals at the office that we have are actually doing very well. I mean, we're signing record high rents in, we've at a number of our properties right now. 929 in Seattle. It's not in downtown Seattle. We're actually in Bellevue, so across the lake, where Amazon has signaled all their growth is going to be in the Pacific Northwest region. It's close to Microsoft. We've got Salesforce as our largest tenant here. We have, our building is the Salesforce Tower, effectively. We just renewed Salesforce in the building. We have Visa, the credit card company, as well as Sony. They administer like the Sony PlayStation platform.
I've heard of all those companies.
Yeah, so great rent roll. We're getting some of the highest rents, in the quality building. If you're one of the top 5 buildings, your business is great in the office building business right now. If you're out of the top 5, it can be a slugfest, So the office that we have is very high quality. We've got, we have the Salesforce building in Bellevue. We have the Google it leases 70% of our building in Austin, Texas. Fantastic tenant, fantastic building. We're getting the highest rents we've ever gotten in the building,
So both Salesforce and, what was the other one you mentioned there?
Google,
yeah, I've heard of them too. Both of them would be outfits that would be looking to maybe distribute their workforce, you would think, by working them from home. Since a lot of their people, I mean, have you seen do you have any metrics as far as how many people are actually working in the buildings? Is there any chance that they will exit those office buildings?
we just renewed Salesforce.
Okay,
so yeah, we took a floor back. We took one floor back, and they renewed, I think, in 6 other floors. So they downsized slightly, but committed for another 10 years. And that's very typical of what we're seeing, is maybe need a little less space for those things you're talking about, but they want to make the rest of their space more just different, so it's not everyone gets their own desk, but they can, if they have meetings, they can bring everyone in, so larger gathering spaces, fewer dedicated assigned desks. So we're seeing kind of a reconfiguration of space. Another high-quality office building we have is in Washington, D.C. It's a block from the U.S. Capitol, and we have Amazon as our largest tenant there. So they do all their lobbying of the federal government, and so out of our building, that's a block from the Capitol. So. And Amazon did the same thing. They gave back half a floor and renewed in the rest. So
I assume that you are still trying to rent that other half a floor?
We are. We've got a number of tenants we're talking to, and we'll probably set a record for rent in the building. So yeah.
Okay.
So well located, high quality buildings are seeing all the deals and are seeing great rental rates. As I mentioned, if you're outside the top 5 or so, it can be very challenging. But we're well positioned to benefit from this flight to quality that's underway.
So what did you guys see prior to COVID that caused you to start moving away from office, besides a crystal ball?
We're not that good, but it was really the higher cost of tenant improvement. We saw rents going up, but they weren't going up fast enough to cover the amount of tenant improvements and leasing commissions that we had to put into these deals. And so effectively the rent that we were getting was lower, even though we were signing good, what we call face rates. We were having to put more capital in, and the cost of the tenant improvements was going up faster than rents were going up. And so that's really what gave us pause back in 2015 to say, it's been good, we don't want to stay at the party too long here in office. Yeah.
Well, I'm sure you're well aware some of your competitors didn't have that foresight.
Yeah.
And seem to be writing them down at record rates.
Yep. No, we've definitely seen that, yeah. Just moving through other parts of the portfolio, talked about office and residential. Retail is another thing. Actually, we're actually under contract to buy a retail center right now, a very high volume dominant grocer in New Jersey with a minimal amount of shop space, and that will be a very attractive acquisition for us. We don't have any malls in this portfolio, and we never have. Our retail is primarily grocer anchored centers. So we look for the dominant grocer in a market. In Seattle, that's Safeway. In LA, or in San Diego area, we've got Vons. We look for the dominant grocer that does high volume sales with minimal amount of shop space, and that's been a very good retail format for us. And so a lot of it's held up very well through through COVID, through e-commerce. Our retail has been very resilient and provided very durable cash flows for us. And so good center that we've got there in North Carolina, Harris Teeter. We've got a couple other tenants there as well, but
I like the name.
yeah, they're the dominant. They're owned by Kroger. It's Kroger's brand in the Carolinas and a couple other states as well. But so we've got good credit on the lease, but they do fantastic sales. We've got a Chick-fil-A out front. We've got a Dick's. Very very strong sales at this center here. So we'll continue actually to add a little bit more retail. We can add it at an attractive basis, but we'll stay very close to what's worked well for us in this necessity retail. But probably most interesting to us on slide 20, I mentioned it earlier, is data centers. And we've got other properties, and these are properties that we call niche or alternative property sectors, because 10 years ago, these would not have been in a core real estate fund like this. But that's probably where we're seeing some of the most interesting areas. And as I talked about growing out of our office allocation, probably going to allocate money to some of these alternative sectors, like data centers have been the best performing property type, bar none, in the industry as well as for us. We just signed a full building data center lease a few weeks ago. We'll have a good quarter this quarter because we signed that lease. Our best performing properties have been data centers for the past several quarters. So very strong landlord pricing power in that space. And we're not investing large amounts of capital into these deals. We're invested into the buildings. We signed this full building lease in Kansas City where we put in $5 million, which paid a leasing commission to the broker for $200 and some million of gross income on the deal. So that was the only cost we put into the deal, and the tenant is starting to pay basically $8 million in rent per year. So the ultimate user is NVIDIA. We've got another data center in the Dallas area that is called CoreWeave, a company called CoreWeave. They went public in the second quarter of this year. Their stock has done really well. They're in a good space, and they're backed by Microsoft and NVIDIA. So lots been written about that, but that CoreWeave or that Dallas data center is one of our top 10 properties, and they pay us $23 million of rent per year. And we've got some additional power capacity that we've identified and worked with the utility company that we can bring to the property or have brought to the property. And we think we've got some good visibility into some more that we can add to that property. So very good. We're doing it. We're not allocating a lot of capital to it, but we've got a partner that's been very good, and we've done well by partnering with them, and we will continue to see good investment opportunities. So that Dallas property is mentioned or pictured on the bottom left of that slide 20. Self-storage, we've got
Darren,
sure.
I just want to tell trustees about 10 minutes for an hour, something like that. So about 10 minutes.
Okay, perfect. I'll wrap it up here. So we got, these alternative sectors, that's about 16% of our fund, and at best we can tell, probably about 12% of our peer group is invested. So we've got kind of an overweight to these alternative sectors again, relationships with some groups that invest alongside of us, but have a lot of operational expertise in dealing with some of these some of these properties, and so would love to allocate additional capital to them. Probably the thing that we're most excited about as a team is our NOI growth. We think we've built this portfolio for NOI growth and really seeing some great opportunities here. We think if we get more of our return from income and grow that income faster than the benchmark, we'll outperform the market in time. And that's certainly what we've seen, but we've got a number of these leases that we've signed, and so are contractual, but they haven't started paying rent yet, and so we've got a pretty good visibility into growing our income. We've got a couple slides on that as well. Slide 24 is our debt maturity schedule. By being a core real estate investor, we don't have as much debt, and we've got a good debt maturity schedule here where we're not overly reliant on banks and we don't have a wall of maturities coming at us. It's left us with a 4.1% cost of debt capital. As you're aware, that's well below the market for interest rates today, and so we haven't added any more debt in this high interest rate environment. And this is a competitive advantage going forward as well. This, long loan term as well as our average cost of debt capital. A couple slides there on just that we use with new investors that are new to real estate, just highlighting the opportunity of what a good time it is to come into a portfolio that's been repriced, as well as coming through a period of some negative returns over the past couple years. But those are highlighted on 25 and 26. Then on 27, just really highlights our returns relative to both measures of the benchmark. You can see we've got total return and income return over all time periods. And so with that NOI growth, you see we've got that lead on the benchmark with getting more of our return from income in place, and we've got good opportunities to extend that lead, we think, going forward. Maybe wrap it up there and see if there's any other questions that I want to make sure we answer before our time is up. I think one thing, Robert, I know you've got DWS, and I think they're a great fund, and I think he wanted to maybe just have us highlight how we might complement your investment in that fund as well. And I think things that come to mind initially are we've got our queue paid off. I think they're still dealing with a redemption queue, so I think they're still on defense. And I think all investors should be participating in buying new investments at this point in the cycle. And that's harder to do when you've got a redemption queue. So I think they're probably still on defense a little bit as far as a portfolio positioning. And I think by investing with us, we're going to be more on offense right now and deploying fresh capital into some good vintage buys for the fund, as well as our investments in some of the alternative sectors as well. We've got that overweight there to our highest conviction things like manufactured housing and data centers as well. It's a small part of this fund, but it's really where we see the best opportunities right now. It's been the best performance, and we see that probably that runway still out there for the foreseeable future. So I'd say we're positioned pretty similar, but those are some differentiators I think that would probably help us complement what you have with them already.
So going back to page 22. One thing that's standing out to me is the expected NOI growth in industrial. Obviously, industrial and residential growth for the first 2 years are the larger portions there. And thinking about the industrial sector just sort of broadly at the market level, not necessarily this growth, but thinking about that market. It's been a great performer, 2014 to 23, top performer sector in the Odyssey. Now that we've got these sort of tariff issues related to the new administration and potential oversupply in somewhere like Riverside, I'm sort of wondering with your new leasings in the industrial sector in the port market, so maybe in Florida, maybe in Seattle, maybe down near LA. I'm sort of wondering what you're hearing from your tenants when you're talking about those new leases. What are they feeling the economic outlook is like just for their own prospects?
Yeah, a lot of them have been enjoying because of the leases they have in place, very below market leases for quite a while. And so slide 57 highlights our lease rollover, and you can see the industrial leases that we have rolling over, maturing or expiring by year. The industrial leases that we have in place are about 17% below market. And actually, the leases that are expiring in the next year or two are like 40 to 50% below current market rents. So they've been enjoying very low market rents, and so moving them up to market is something they've been expecting for a while. They know they've had the benefit of their in-place leases. And so, yeah, we've been, as I said, we signed that lease in Ontario. We've got a property that's leasing up just on the north side of Las Vegas that we just built right along I-15. The Port of Houston, we just leased up a property there, so that the NOI growth is very, the 25 number is 100% contractual basically, and the 26 number is something like 60 to 70% contractual at this point. So it's something we've got visibility into. The
businesses are confident. They're feeling confident, like, hey, we're going to stay here. We're going to potentially sign these leases again.
Depends on the business. I mean, the people that are highly dependent. We've got a tenant actually in Southern California. They've hired a bankruptcy consultant, and they depend on global trade, and so their business is down significantly. They had an asset liability mismatch where they committed to long-term leases, and their contracts with their customers were short-term, and so they're struggling. So I mean that is out there. We've got one tenant in Southern California with that, and we've got one tenant in Seattle, and we're taking the approach much like we did with COVID, that we're going to be partners. We want to be there with them when they come out of this. I mean, not all of our tenants are global trade dependent, but it was the same approach we took with tenants during COVID. We're like, hey, we'll help you get through this. We're not going to hammer on you for rent and evict you because you're not paying. Our prospects aren't great for releasing it right now, and we're going to help you bid for new business and help you be a survivor in this. So that's it. It depends on the tenant profile.
Thank you.
The basement cut, did you say by how much?
Yeah, question.
Data centers, how do you plan to avoid grid capacity limitations?
That's something actually that's given us good pricing power. If we have the power, it's great. It means we can charge more for it, and we've got leverage with some of these tenants. So we see some of these grid capacity issues as something worth watching, but something that's giving us good landlord pricing power as well. So we'd be fine if it'd make our rents go up more if there was more restrictions on power. So, but not that we're hoping for that, but that's just what's given us good pricing power.
Are there any further questions from trustees?
Thanks for having us. We think after not marketing this fund really for 2 years, we think it's a great entry point to come into a portfolio that's higher quality than it was a couple years ago. It's been repriced significantly from what it was before, as well as we're positioned well. We were very thoughtful through this disposition phase of how we wanted the portfolio to look at the end of this after we returned capital. And so we wanted to be in the markets we wanted to be in. We wanted to be in the property types. The portfolio positioned exactly how we, when we had a disposition plan of selling properties to kind of meet redemptions. And so the way the portfolio is positioned is exactly how we'd want it today. But
okay.
Thank you.
Thank you.
I believe we should probably...
We can bring them right in next. They're here.
Well, I'm going to pull the trustees and see if anybody would like to take a break, would prefer to take a short break. For
5 minutes?
Stand up at least.
Okay, let's go until 11:30 then. Okay, so it's going to be longer
How
than.
about, what about a 5-minute break?
Yeah, 5-minute break.
Oh, okay, well then, 11:25. You talked me into it.
Thank you very much. Appreciate your time.
Thank you. Safe trip back.
Thanks for having us.
Have a good day. Wait, according to Jeff, until that is.
Okay, all right.
Yeah, take a seat, guys.
Thank you.
Try to speak into the mic. We've got the mics here. They're plenty loud if you just speak at them. If Cal asks you a question, we don't need to turn around.
Don't turn,
and
just-
talk to them.
Okay.
Just talk this way.
Okay.
Yeah.
Yeah, we can hear you.
Ignore the people behind you.
No.
Good, how are you? Pat? John.
Hi, John, it's Jim.
You got enough just in case you want more?
Sure.
Okay, all right. Fair enough.
Okay.
Scott, if Scott's ready, let's go ahead and start this up. We are on item 2D, LaSalle Investment Management, core real estate presentation. Welcome.
Thank you very much. Thank you very much. And good morning to everyone. My name is Chadwick Cunningham. I am a relationship manager. Oh, thank you. Thank you. I'll be sure to tell my mom. Thank you very much. I am a relationship manager with LaSalle Investment Management. I've been with the firm now for over 20 years. I was actually with JLL for about 8.5, been with LaSalle for about the last 11.5 years. I am based in Chicago at our global headquarters. I work with institutional investors across really the western half of the United States. And so really appreciate the opportunity to be with you this morning. Joining me are Jim Garvey, Fund President and Portfolio Manager for LaSalle Property Fund, as well as Pat Pelling, Co-Portfolio Manager for LaSalle Property Fund. And with that, I'll be quiet and turn it over to them.
Great. Well, we'll kick off, and thank you, Robert, for moving us forward. Just one more. We have a statement to start it off, and really what to focus on is, our objective is to provide attractive, risk-adjusted core returns. And then the second kind of key piece of that statement is what we focus on is areas where demand is strong, but the potential for secular disruption is low. And so that is something we're going to show visually later in the book, and I think that'll help kind of, show why we're investing in what we have invested in. A number of facts and figures, kind of the key metrics. It is 15 years since the fund inception. We started with no assets. So at that point in time, no seed assets, and now we've grown 98 investments to roughly $9 billion in GAV, $6.5 billion in NAV, and that leaves us with a 25% loan-to-value ratio. Our contribution queue is $184 million. Our redemption queue is $9 million. I think what's even more interesting is if you walk it back to January 1st of 2024, our contributions since that point in time have been $800 million. So we've really invested the other, little over $600 million. Our redemptions in that same period, that same 18-month period, taking, let's say, through June 30th, or even for that matter, up to today, redemptions have only been $13 million over that time frame. So had a very strong kind of ratio of contributions to redemptions. And then on the next page, we'd like to start with why LaSalle Property Fund, and the reason for that is, there's a lot of similarities between Odyssey funds. We have a lot of things that we have to comply by in order to qualify to be an Odyssey fund, called, inclusion criteria is how it's referred to by NACREIF. But ultimately, we do have some big differences. And we think one of the big differences for LaSalle Property Fund is we have superior portfolio positioning, and probably the reason that we've had such good success with regard to new contributions. And what I mean by that is we've had a long-term underweight to traditional office since the fund started. And so right now, we still have that underweight. We're at about 6%. Odyssey's about double that. Because of that, we've been able to gain exposure to a lot of other areas that have helped us and been accretive to our returns. That includes medical office, life science, self-storage, and single-family rentals. We find ourselves, we believe, in the most desirable sector on the retail side, where we have grocery-anchored retail exposure. And so what grocery-anchored might mean is, but I'm going a little bit south of here, but many years ago, for instance, I bought Strawberry Village for LaSalle. So for those who know that, down in Mill Valley, kind of the first grocery-anchored center after you get off the Golden Gate Bridge and head north. So, and that's part of the problem. Maybe many of the names of shopping centers aren't known as much as what they are. So the nice Safeway and In-N-Out Burger as you get right off of the Golden Gate Bridge and you head north. And so we invest in those type of properties, and we have high quality retail both in San Jose. We have it down in the South Bay area as well in LA. But they are. Oh, sorry.
Was the Strawberry Center also owned by UC at one time?
It was. When we bought it, it was actually a closed bid sale, which is a little bit different, where you had to mail it in and they weren't going to open the bids to the next day. More often they have kind of an active broker process. But you're absolutely right, it was UC. And so, grocery anchored generally, I'd say, is where folks are the most comfortable and what has performed the best. We have about 70% of our retail in the grocery anchored, so we're happy to have that. Also happy to have, no regional malls nor hotels. When we started our fund out, we prohibited it from investing in hotels, thinking that hotels don't really fit with a core fund. When all of your revenue leaves almost daily, and you're having to manage, things like restaurants and other amenities that didn't fit. So we have no exposure to either of those and never have with regional malls or hotels. And then also, our leverage is appropriate for an Odyssey fund. As I mentioned, we're at 25%. And then moving down just a little bit further to, the next kind of section here, really substantial firm resources and strong alignment. And what we've included in that from firm resources really is the senior management team, from the LaSalle Property Fund. It includes Pat, myself, and a gentleman, Ryan DeRoos, who's our CFO. Ryan and I have both been with the fund since its inception 15 years ago. Pat worked directly on the fund for a number of years earlier in his career at LaSalle, then moved on to acquisitions where he bought properties for the fund, and more recently had been running acquisitions before electing to come back and join us in LaSalle Property Fund. So great depth of knowledge on the LaSalle Property Fund, and a team that, as we look at the years here, it's 27 years of on average real estate experience, 22 years on average with LaSalle. So excellent continuity. One of the other things we benefit from, we are a wholly owned but independent subsidiary of Jones Lang LaSalle, but we have access to information from JLL, and they have a total of 100,000 employees, all in real estate. And for us, that's a very fertile area for getting information that isn't quite, let's say, public yet, if you know what I mean. It hasn't yet been done. If you want to find out the latest trade or the latest lease, and you can call up your colleague at JLL, that's a good way for us to have access to that. And then we also have alignment in that we're co-invested. So we co-invest both at the firm level and at the individual level, with the firm having most of the investment, but also the fund team being invested with a total of $19 million of co-investment. We like to talk about both our top-down and our bottom-up advantage in terms of investing and sourcing. So from a top-down, we have a very well-known research group. Ultimately leave it to Callan to comment on that as well. But, very highly thought of, and they have proprietary data. It's very data-driven, top-down analysis of where they think we should be investing, both on a property basis as well as a market basis. But we also do,
to what extent, and I almost hate using buzzwords coming from a master's in statistics program, but to what extent you use AI?
To what extent? I would say right now we're mostly developing AI tools. So our research group would talk about, and I'm thinking of, they just wrote something, so here's like the 6 things we're working to develop. But most of what we have right now, at least in the research group, is not, I'm going to say their tools are not AI driven. We have a couple of data scientists in that area, and so very, things that we're doing are meaningful and statistically significant, let's say, to make judgments and decisions. But AI, Pat, I can't think of too many AI tools that are, let's say, finished. And then AI is always a little bit interesting because, you're still trying to work out the hallucination thing and a few other things. So, but I would I would say that is more work in process, and yet if you were to ask our researchers who write within every investment committee book that's required for every acquisition, much of the information that they would glean, no doubt, would be through AI. But a pure, let's say, AI tool that identifies the property type to invest in or the market to invest in, not yet.
Yeah, one thing I would add, we do have an acquisition tool. It's not fully AI based, but there's an AI application where we can look at debt on properties and sort of see what's coming up to mature and where we think these are highly saleable probability properties. And it's allowed us to go to those owners directly and try to get opportunities off market. So we are going through that process right now. We haven't been successful quite yet, but it's a new tool that we're working on and that we've been using.
Great. And now I'm going to jump to the other side of AI, the other side that's not AI, and that is, certainly the top-down information we get from research is very helpful, the fair value analysis they do on the property types, but we also do a lot of deals off-market. And so, it was very much an on-market deal. When we talked about Strawberry Village, that was a bid, but about a third of our deals come just from relationships, groups that know us well, have worked with the firm over the years, and want to transact with, someone that they've had a history with. So that's been very important. And then lastly, I'll note on the value creation side, LaSalle is a real estate only firm. So when you come to LaSalle, you come to be kind of, I don't want to say in the weeds, but really working the assets directly and hard. And we distinguish ourselves from most of our competitors who have, bond sectors, they have equity sectors, et cetera. And so you may, over the course of your career, do any one of a number of those things. In our case, we are solely a real estate shop. And then lastly, but certainly very important, is just consistent outperformance. So we have outperformed the Odyssey Index 1, 3, 5, 7, 10 years. That is not only on a total return basis, it's also on an income basis. And it's also on a net and gross basis. So after fees, that outperformance sticks as well. And the next 2 pages kind of provide the backdrop of, how significant and consistent that outperformance has been. So if you look at, basically the legend here, you'll see, LaSalle Property Fund is the darker of the 2 colors, and more the lightish bluish gray color is the Odyssey. And so over time, again, consistent outperformance. We do note we provide net returns as well. Actually, we have to. The SEC requires us to. So after fees, you can see what the spread is between Odyssey and LaSalle Property Fund over time. And you'll notice, if you look closely, that it is a little bit wider. So that's one measure of how to think about our fees as being generally competitive and favorable relative to other Odyssey funds. The next page focuses only on income, and would note that we have a consistent history of having greater income returns than the Odyssey. So this shows 5 years, but if we went back 15 years, there's only been a quarter or 2 in that history where our income return has been less than the Odyssey. So most recently, we're about close to 37 basis points, almost 40 basis points above in the most recent year the income return for the Odyssey. So in some ways, by having a better income return, you just start out in the lead. So we're already ahead. Hopefully, you can add to that lead with outperformance and appreciation.
And Jim, can you talk about why that outperformance is there?
Yeah, I think, one of the big reasons is going to be occupancy. We almost always have higher occupancy. And when you look at our quarterly reports that we provide, there's a page on each one of the major property types. And it has been, as long as I can remember, that we have a higher occupancy in each of those 4 property types relative to Odyssey. So if you looked at it today and said, how's your occupancy relative to Odyssey? The answer would be it's higher in office, it's higher in industrial, it's higher in multifamily, and it's higher in retail. So I think that's been a big help to us. Our financing has been, I think, attractive. I can't comment exactly on how relative attractive it is relative to the other Odyssey funds, but I think that would be a driver. But mostly it's keeping assets well leased, and I think that's honestly just a good sign, because and probably a good sign of the ability to grow rent, because what allows you as a landlord to have increases in rent is to have strong occupancy. If your occupancy is soft, your negotiating power is not so good. So I think there's kind of 2 things. One, the occupancy in and of itself is an advantage, and then the byproduct of that level of occupancy is a stronger negotiating position.
Thank you.
Mm-hmm. Okay, and then jumping to the next page, this is the page I referred to early on and said, hey, later on we'll have a visual which shows where would you want to invest if you wanted to chase those property types where you see strong demand long-term, but also lesser chance of a secular disruption. And so a secular disruption is kind of thinking of work from home and office and that type of thing. Those areas where, change is more likely to occur. And so when you look at our portfolio, what you'll find is that the vast majority of our portfolio is invested up and to the left. So warehouse, medical office, single-family rentals, we're just getting into some affordable housing now, so we're kind of at the beginning of that, but apartments, industrial outdoor storage, self-storage, we invest in all of those, and also invest in retail, life science. So that's our focus, and we think that's probably a significant reason that we've had this kind of steady outperformance is we're not betting on one property type. We don't have a big overweight saying we're going to put everything in this one property type or even two property types, but we have what we believe is a diversified portfolio that gives us a number of, if you will, good bets. And then this is also to show, why we're really happy to have less office. So you can see what's happened to office. And office is interesting in that you can see over these histories that it has always had higher vacancy. So if you go all the way back to 2001, higher vacancy throughout, but it really peaked, after the pandemic, starting to get a little bit better now. But we're very happy to have a fund that only has 6% exposure to traditional office. I think we're fortunate to have, 3 of our office buildings are about 100% leased, so that which we do have generally is strong office. And then the other thing I think which is good as you think about of investors is, generally speaking, for the other property types, we're at a position where the vacancy is less than the long-term average vacancy for those property types. So you can see in this 2024-25 period that generally we're lower than the line would be historically. Industrial is notable in that it did add a lot of vacancy recently, so that's been a little bit softer, and we've been, quite frankly, using that as a buying opportunity. And with that, this is the picture when we say, okay, what does the portfolio look like? This is what it looks like. Again, a halfway to traditional office feels very good. Life science and medical office, we have good exposure to those property types. There's good reasons why. Pat's going to cover those in detail a little bit later, and so I won't go into detail, but you'll notice as it is covered in detail, the exceptional high quality of the portfolio, both with regard to building and tenants. Residential, we like residential. We do have an overweight. You can see it's an equal weight on the multifamily, overweight on single-family rental. So single-family rental, we don't own any single-family rental in California. Generally, the single-family rental we own is in more modest price point markets. So you would see it mostly in, let's say, the Southeast. Home prices $350,000 to $400,000 a home, and folks look at that and say, hey, this is a nice opportunity for me to be able to house my family in a rental market as opposed to housing them in just a multifamily property. And so we're happy to have exposure to that, given the demand for housing. And then moving on to retail, this is where the colors do code it as 70% in grocery anchored for us. That compares to a little bit less than 40% in grocery anchored for Odyssey. And industrial, as I noted, we actually have more recently a deal now under contract. It's going to take us up to 33%. But we've been using the current opportunity of a little bit softer industrial, much softer than it was, let's say, 3 years ago, to buy industrial, move our exposure up a little bit. We've also been moving our exposure a little bit up on self-storage, where we already have a slight overweight at 5%. And coincidentally, last quarter, when we talk about outperformance, the 2 property types that drove outperformance last quarter were, for this fund, industrial and self-storage.
No senior housing?
We don't. We've looked at senior housing, always, that secular disruption concern is higher with senior housing. I think there's a lot of pieces of the puzzle. It is kind of interesting, I think, from a timing play, in that it has, quite frankly, been so difficult in the recent past, and people are seeing it now starting to come back, that it is, can be a timing play. But the medical component of it, the food component of it, one of the things that happens is if you start to lose a little bit of occupancy, you find your income drops really quickly, because you actually can't drop your medical costs at the same pace, and you're running a kitchen, so you can make a little bit less food, but the operating efficiency of running a senior housing facility is really it's really difficult if you have any drops in vacancy. And it's also difficult to stimulate demand. When you look at the, let's say, traditional multifamily, you usually say, okay, we're running a rent special or something to get our occupancy back up. In senior housing, given that so much of it is demand driven based on need, it's hard to stimulate, aggregate demand. So you might stimulate some demand in multifamily. For instance, if you have somebody who's living at home and you say, oh, gosh, I can get 1 or 2 months free, maybe I can now work with my budget. Your decision to move into senior housing tends to be, more necessity driven. But there are some senior housing selling high yields today, and so I think there are some people who will be able to get in, and if they get out before they experience some of the challenges. Yeah. Well, and there's all sorts of issues. I mean, if you think about even, it's actually a significant one. Many of the senior housing operators are ones that would have said, okay, if you can come in and you qualify and you can show that you have, let's say, X years of income, then that's okay. Then we will take you on, and if your funds run out, we're then gonna, look to Medicaid. But now you're getting into situations where you're betting on the reimbursement, policies of the federal government, which we'd rather not do. So we haven't jumped into that. It does strike us as good demand, and it's interesting because it's on that chart, so we'll show it is good demand, generally speaking. You can see it's high up here, but it's also pretty far to the right, that is there's a lot of things you have to worry about. And so from a risk, it's not the demand side, but from the risk side we worry. And then next, just moving on to what we...
Where do you think on that old picture, the JLL sort of network helps your investment decisions the most?
Which of the property types? JLL does... trying to think, big property types for them, industrial, they do an awful lot. They do an awful lot in office, so that's an area where they have, a great deal of knowledge. They do less on leasing and management, on the apartment side, quite frankly. We do use them on the retail side as well. I'm smiling because we always just hire whoever the best operator is. We can't hire JLL because they're related. And the reason I'm smiling is when we bought Strawberry Village, the group managing it was actually a California-based group called Shelter Bay, and we kept them on as the manager. And JLL kept asking us, gee, we'd like to manage your properties in California. We said, we have a better operator. So JLL then bought Shelter Bay. So at some point, you say, okay, that worked out, and we do use them on some assets. So retail, they do some as well, less on multi, but in particular, I'd say industrial and office are their greatest strengths.
Okay.
And then we're going to bounce to page 11. Yeah, thanks. And this shows we started out with this underweight to office, so it's not something, we changed as we headed into the pandemic. We've had it in place since, 2010. We've said it will be a long-term strategic underweight just because of the risks related to office and the expected returns. That's been a good idea. The two things we got into most early for the fund were truck terminals and medical office. And those were things that we were buying as a firm even before the fund was founded. But those have both been aids to us in terms of good performance. We also got in relatively early to both self-storage and life science. In particular, in the latter, very important, because if you got in late to life science, you probably bought something overpriced and lesser quality. So getting in at the right time was very meaningful. And then most recently, we've done something called not only single-family rental, but industrial outdoor storage, and this is an aerial view. And one of the takeaways would be, why is it outdoor storage? Is you don't see a lot of actually building on this property. And in fact, the two things on the upper side of the picture, those are canopies, so that they're actually open, but just for storage. So these are areas where more land, ultimately a little bit less building. And then I'm going to hand it off to Pat to take us into medical office.
Yeah, so medical office is one of the niche property types that we're heavily invested in and we like to highlight. As Jim mentioned, in general, we like sectors with strong demand side fundamentals and limited operational risk, and we think medical office is absolutely one of those sectors. I mean, I'm not going to go through everything on this slide, but as you can see, we have an aging population, and that sort of correlates with more doctor visits on an annual basis. So again, we feel good about the go-forward demand fundamentals of this space. LPF, we've always targeted buildings with very strong tenants, investment-grade tenants, or physician groups that are well-financed. And we really like to target assets with sticky uses. So we're not looking for, medical office buildings that are housing back office of hospitals, if you will. We like outpatient surgery centers. We like imaging, things of that nature. Those uses come with really heavy tenant demand, tenant investment in those spaces, and so they are much stickier, we feel. LaSalle does have a really long history and track record of investing in medical office. We've been doing this for over 20 years, and we do have fully dedicated senior folks, both on acquisitions and asset management, that solely focus on medical office. So we feel like we have a good competitive advantage there. Jim's mentioned this. The fund is currently 6% exposed to medical office. It's the same as traditional office, so we've always kind of held an equal weight relative to traditional office, and I think on a go-forward basis, we would obviously continue to favor medical office.
So you're taking care of the old folks
we
in the
are.
area.
Exactly.
Yeah, it's not on the housing side, but
So,
where they come.
I think obviously medical would have more demand going forward, but is there the money to pay for it? There's been a lot of talk on the federal level of cutting funding. Do you have any concerns with reductions in funding?
Yeah, I think our underwriting, the key is probably two things. One, what we focus on very heavily is that the buildings we get involved with have a very high percentage of private pay. So it starts with, typically we're like 85% or even higher on private pay. Second is you have a hospital system that is very, very strong. So if you look at the hospital systems we have, and Pat's going to get into it later, so I won't share with you now their credit ratings and their names, but those are also, very, very strong. So that's a key part of it. Yeah, if you have failing hospital systems, and you have hospital systems that are solely reliant on basically the government funding, and that's a dangerous place to be. Not where we are. And when you look at our buildings in particular, and I'll give you one example, which is Vanderbilt University Medical Center, which has 400,000 square feet. Well, they had 400,000 square feet with us in the property that we own in Nashville. It's their biggest position outside of their campus. In the last year, they've taken down another 100,000 square feet. So we are generally seeing from our tenants the desire to expand, and they've told us in that building, it's a mixed-use building with retail and quite frankly, retail and medical office. And they've told us we will take every space we can get, every square footage. And so I think, if you have a high percentage of private pay combined with just the growth behind it, and the growth is, as Pat's shown here, is really strong, and that is, you look at your visits over 60, 45 to 64, 3.7 visits a year, over 65, 7 visits a year. That's a lot of incremental demand. And that's visits growing, but also obviously the age cohort above 65 is growing too. So what we've been finding, certainly we focus on, again, the credit rating, the private pay, but the other thing I'd say that, we're finding is this level of demographic demand is showing up in the demand for more space. But if you have bad credit or you're relying on government pay, you have a different risk profile.
Yeah, thank you. So this slide, we like to show kind of where the majority of the fund's exposure is on a geographic basis. And as you can see, predominantly we're in primary markets and markets with strong employment stories. A couple markets that we like to highlight, San Diego, you can see we have a meaningful overweight relative to Odyssey. That really comes through the exposure in life sciences to one large campus where we have two strong tenants. One's investment grade, one has a market capitalization of over $120 billion. And something to note about that campus is, we have a lot of term, so 6+ years of WALT on that campus. And two, both of those tenants have been consolidating operations to our campus in that market, so shutting down other locations. So we feel on a go-forward basis, that campus is mission critical to both of those tenants' operations, so we feel great about that. Los Angeles is an area where we're slightly underweight. I think we're okay with that for right now. Something to note about our Los Angeles exposure is we really don't have any meaningful traditional office exposure, which has been good. And we are equal weight to industrial, and our industrial for the most part is really well leased and long-term leased, so we don't really have a lot of exposure right now to the softness of the LA industrial market. And then finally, Boston. We are underweight to Boston. This is one we would like to fix and increase, if you will. We like Boston quite a bit. Something to note about our exposure in Boston, again, no office. Right now our exposure is all through industrial, medical office, and self-storage, but it is a strategic initiative of the fund to try to find good investment opportunities in Boston. We would love to find a good multifamily asset or something along those lines out there. So that's definitely a top priority for us. Next slide, Jim went through this at the beginning. We just put it into pie chart kind of format here. Two things to note. You can kind of see the composition of our investors. We are heavily U.S. pension funds, so you can see that. And then secondly, what I would note is, having an inbound, equity queue, if you will, has been really advantageous for us to take, advantage of the current market conditions. Over the last year, I would say we've done a lot of industrial and self-storage at our below replacement cost, really attractive entry points. And having been in acquisitions for the last decade, I can tell you there haven't been a ton of times where you could do that. And so having capital to deploy in this market, I feel has been a nice advantage for LaSalle Property Fund. Okay, the next slide, we were showing our top 10 properties where we have the most exposure. Something to note here, only one asset that has more than 3% of our fund's exposure, and that is the life sciences campus I mentioned earlier in San Diego. And again, a really nice story there where we have two great, strong tenants, investment grade, lots of term, and investing a lot in the campus and their space on a go-forward basis, so we think they are quite sticky. The rest of the exposure, no traditional office in our top 10, which we think is highly beneficial. And then we have really great diversification between location, actually no market overlap between the top 10 and property type. You'll see a lot of different asset classes in that top 10, medical office, industrial, multifamily, retail. So we do have really nice diversification amongst our largest exposures.
I have a question about Illumina. I didn't do all the research in the world about the company Illumina, but I know the company there at that site. I saw that they are put on the ban list for China in relation to all the things that have happened with the administration. I sort of just wonder from your perspective, are you concerned with that at all? I don't know how much their gene sequencing line of business through China actually is. I didn't go dig through any of their reports, but I just saw that and I just sort of wondered, at 5%.
I'd say the public market, adjusts pretty quickly, and so when that news came out, you did see a drop in their stock price. I think it was roughly of about 10%. So they did feel that. So it's not it's a meaningful driver of their business, but not, a huge driver. Ultimately, they maintain their investment grade credit rating. That wasn't impacted at all, and they also, continue to maintain a market capitalization of greater than $10 billion. So I would say, it appears that, Illumina, being on the ban list in China is not something that would ultimately be problematic with regard to the success of the entity long term, but it did show up, in their stock price and the impact of it in the short term. We are seeing, I would also say, at our buildings, there's other tells, quite frankly, that you see, and they're continuing to invest significantly in the buildings that they have with us. So from a cash flow standpoint, very strong company as well with regard to free cash flow, and a good amount of that free cash flow is coming in our buildings.
Fair enough. Thank you.
It's the Eastern Inland Empire. So
Los Angeles.
Yeah, in Los Angeles. Sorry. So yes, if you wanted to head, let's say, probably it's really close. If you cross, there's a point where I think you can cross the street and you're in Fontana instead of Bloomington. Yeah. So Eastern Fontana, I guess.
Yes, Jim had mentioned the strength of the income term and the income return and the outperformance there relative to Odyssey, and it strongly correlates obviously to occupancy and a good story that we have here. So currently, great occupancy at the portfolio, 96% on residential, 95% in commercial. Something to note about the commercial occupancy is during this quarter, Q3, we actually leased our largest traditional office vacancy, which was in Denver, 100,000 square feet to an investment grade tenant for over 10 years. So actually we're going to see a bump up in our commercial occupancy, and that's going to go up a little bit in Q3. So very, very strong performance and occupancy and very defensive portfolio. And we think that's appropriate for a core fund in the current market conditions. So we really like the way the portfolio is positioned at the moment. And something to note, you see the historic occupancy at the bottom. We never really dipped below 91, and 91 was post-pandemic. And something I'll say about that is the 91 was a little exaggerated as well, because we were launching a large SFR venture where we were buying homes, renovating them, and leasing them. And ultimately we have a $400 million exposure to that space. And so there was a lot of vacancy in the SFR portfolio as we were fixing those homes and renting them. And today that portfolio is over 95% leased. So, I would say without that, we were probably never below 92, 93 post-pandemic. And then another thing to highlight relative to the defensive nature of the portfolio and the positioning is we really have minimal lease rollover over the next 5 years, never more than 15% in a given year. So another success from Q3 was we renewed our largest industrial tenant in Los Angeles. And that was our largest exposure for 2026. So actually that 10% on the slide for 2026 exposure is now down to 4%. We have very minimal exposure next year. 2027, we have a few office renewals, and we think at least 2 out of those 3 are renewing. One might contract, but they are going to at least renew 2/3 of their space. So good stories there on the renewal basis, at least in the near term. So a nice defensive position.
Okay. Thanks, Pat. And just jumping into fund financing quickly, we'll only hit a few highlights. One, we've mentioned loan to value at 25%. Weighted average interest rate currently 4.2%, and then roughly a weighted average term to maturity of about 3 years. We are, as we look forward in 2026, one of the things we're thinking of doing is, you see this orange block, it's a term loan with variable rate financing. We believe we can replace it at better financing with permanent financing, so we're likely to pay down a meaningful portion of that in the next year, and instead extend out later and also lower our interest rate at the same time. We have about 13% in floating versus 87% in fixed. We think that's the right thing to do. Generally speaking, for a core fund, you should have about that ratio fixed. We don't want to take risk, in the financing market. And then would note, our portfolio again is about $9 billion. So having, let's say, roughly $600 million or so in most years, in kind of some of the bigger years coming due. Very comfortable for us to handle that financing. This is kind of a level of detail is probably not needed, but we split the financing between private placements, which are generally funded at the fund level by an insurance company, and mortgage debt, where we're actually just placing debt on the property, one property, and having the debt secured by that. With that, we'll jump over to our sustainability overview. Pat and I come fresh from a call this morning on SB 261, State of California reporting requirements for sustainability, and we are qualifying because this fund has more than $500 million in revenue. So I think that probably makes us, we're the largest fund at LaSalle, maybe the only fund at LaSalle that qualifies, but we were getting a download from that. But the important thing really is not the details of SB 261, which we're just getting familiar with, but, and we do have someone on our team who works on that, but the firm also has a sustainability group, and that really makes our job, possible. We don't have the ability to keep up with every regulation, building performance standard regulation that you see, and yet it's important, because if you don't, in a number of markets, you could end up with a fine, so the economic impact is meaningful. And similarly, we do a value at risk study, which it kind of, there's a little bit of a heading there, value at risk, on every asset that we acquire. And what that says is, what is your risk, basically over 100 years, expected as a percentage of value that could be lost to, one of the perils of, fire, flood, high wind, etc. And these are, this morning examples. When Pat and I were talking again, he said, hey, I just got a call about a multifamily property in Florida, that's in a floodplain. And we said, well, absolutely not. We passed. And you knew exactly where it was. And they said, here, would you be interested? And said, it's not a perfect science as to exactly, how these perils might play out, but there's no reason not to take heed with what is an expected risk. So we'll take heed, and we'll buy those assets where we say, okay, at least on the knowledge we have today, the expected risk is less. So we're conscious of, various risks that you have. We do maintain, high quality insurability on all of our assets, and we want to make sure we can maintain that. So we do have, the great thing is we have an active group, and we're doing, quite frankly, a lot of, neat things. And we have a parking garage in San Francisco that we were able to relamp, and the return on investment was fantastic, because not only did the energy cost drop dramatically, but the local utility gave us a nice bonus for doing it. Tesla's finding it likes a lot of our locations and is paying us generally to put chargers in, and giving us $50,000 to $60,000 a year in income to be able to install those at some of our locations. And then we're doing a lot, just you can save in many different ways. You can save in water, save in waste, etc. And we're finding with our sustainability team that they're doing a good job of finding those opportunities. That includes as well in Walnut Creek, we put some solar panels on top of a apartment building that we have there. So a lot of activities. It is all specific to assets. So it's a plan asset by asset. There isn't a general, gee, we're going to do this, because we want to do this, even if the cost is, not economically positive. So it is done with an eye to, the economic benefits. But we've been able to do a lot. And I think the team that we have in place in particular, puts the fund in good position to really do the hard work and the analysis on every property. And then we get the benefit of just reviewing it at the budget to make sure that the economics are okay. And with that, and this will be kind of a summary sheet before the appendix. I'll go through it real quickly, and I know there's a few things we want to cover in the appendix. But, reminder on strategic, property weights, traditional office has been an underweight always. The next is, strong research. In fact, they are every really quarter updating the best markets, sub-markets to identify for us to invest in. Tactical opportunities that we've taken have been medical office, self-storage, life science, and residential. And then I would note we do have higher quality properties. So if you look at the two properties here, good example of them, very high quality office building in Seattle, and then very high quality, that's the Illumina building, on the bottom. And I think just by the virtue of being a little bit younger fund, we're only a 15-year-old fund, our emphasis has been on newer, higher quality, and our buys, we don't have any buys that happened before 2010. So these are all, generally buildings that are current, very competitive. And then the moderate leverage is really just, I think, really consistent with where an Odyssey fund should be. But we do comply with that. We're not out pushing leverage north of 30% by way of example.
Yeah, and something we were asked to put together for this meeting was, how does LaSalle Property Fund complement America's REIT 2? Another competitive fund of ours. And the answer is we think it complements it quite well. And a few things we'd like to highlight is, LaSalle Property Fund, as Jim has mentioned many times, we have a strong underweight to traditional office at 6% versus the benchmark at 12%. REIF is a little bit higher at 13%, so we kind of blend that pretty well together. We are overweight to residential, and I think we'd like to keep that overweight, and a lot of that's driven by our single-family rental exposure, the scattered site exposure. REIF is a bit underweight to multifamily, so that's a nice complement. We are at or slightly below on industrial, they are above. But something else and something big we'd like to highlight is we have an overweight to self-storage, and strategically we'd like to keep that. Self-storage for us has been a source of outperformance, and as of late it's been a really strong source of outperformance. And so we really, really like our self-storage portfolio, and REIF currently does not have any exposure to self-storage. And then on the retail side, no mall exposure, and as Jim had mentioned, 70% of our retail has a grocery component, so a really strong, kind of low beta, durable cash flow retail portfolio that complements mall exposure quite well. Yeah, and then this also just has the weightings by property type, a little bit overlap with what I just said. Another thing to note is you'll see the life sciences and medical office. We've talked about how much we like those, especially our entry point into life sciences, which was early, with fully leased, good tenant type assets. So we have a nice overweight there, which is a nice complement. And then again, industrial being a little bit below relative to a strong overweight for REIF. But again, I think most of this was covered on the last slide.
And just so trustees are aware, this diversification slide is also part of Callan's slide deck. We had looked at that previously. And of course, I had asked the strategies to provide this extra additional information.
What does RA2 mean?
It's the reef.
Yeah,
Reef
America's
America.
too.
Yeah, that's
Yeah,
their
it's a formal title.
Yeah, that's a formal title.
We refer to it as DWS in our materials.
Oh, sure. There you go.
Yeah.
And then we can go through, we've got some information here in the sector strategies with a little more detail on each of the major property types. Happy to go through that if we have the time to do so.
We do have the time.
Okay.
Any questions from
And I'll be
trustees?
rude, I have a commitment, I have to leave, and that's when my alarm went off.
Okay.
I apologize, so.
Yeah,
It was nice meeting you.
Appreciate the time.
Appreciate the trip you made.
Nice meeting you.
Nice to
Thank
meet
you.
as well.
Thank you.
Pat, you want to kick off with the residential side of things?
Yep.
I saw you move.
So we can go to the next. Yeah. So residential, these are kind of now walking through our broader sector strategies. I would say our predominant strategy in residential has been suburban, really strong school district type plays, and we like those. So there typically there are barriers to entry in really good school districts. There's a little bit of NIMBYism. They don't want a ton of density, so we like buying apartments where there are barriers to entry. We have done some urban apartments. In general, we really like to be in strong employment nodes with really good amenities. We had one in DC here in the Noma area near our Grand Central Station. We also have a nice property in Minneapolis in the North Loop, which is the new hub where there's a lot of office, restaurants, lifestyle. So when we go urban, adjacent to strong amenities, adjacent to employment, and then single family rentals. We've mentioned this a few times, but when we entered single family rentals, we really wanted to do it in a scattered site strategy. And the reason being, the other strategy is build to rent, where you buy, let's say, 300 homes. They almost act like an apartment community. They're right next to each other, have common amenities. In our experience in looking at those, they had been further out. They tend to act more like apartments, and we wanted something that was sort of different. And what's nice about scattered site is you get a much more broad exposure to a market in scattered site. I mean, we're in all different submarkets when we buy scattered site. Residential, we're more infill, if you will. And we get the broad market exposure is important. We have history, buying assets in gray markets. If it's the wrong asset, you don't get the performance benefit of that strong market. And when you go really broad and scattered site, we felt like we would really get the benefit of choosing the right markets, and that was a real reason we did that.
Great. And then moving over to industrial, fairly simple. I mean, we invest a lot in the major path of good markets. So 3 examples for those are Los Angeles, Chicago, Atlanta. Those are big, markets that are central hubs for larger geographic areas. Generally buying higher quality, newer product in each of those markets. And then also we have these truck terminals, which we've been investing in for a long time, and the firm has been investing in them even before, the great financial crisis. So we got to see how well they performed through that stressed period in the economy, and was convinced it was a good property type to have in our portfolio. So that's where the Bloomington property that we mentioned earlier actually is in this truck terminal portfolio. It's kind of a very clever story, so I'll highlight it here, and it's very recent. But we went to our tenant in the Bloomington portfolio and offered to buy out their lease because their rent was 200% below market. So that is actually what dropped the occupancy, the lease rate, to 85% in the portfolio. We since, and as of today, the portfolio would now be about 98% leased because, as you saw, Bloomington, one of the largest tenants in the portfolio, it's a meaningful part of our industrial portfolio. But the bottom line is we actually released it quickly at more than 210% above what the tenant's rent was, and the increase in value to the fund was over $40 million just based on that creation of value. So we always owned the building, but the tenant had 24 years of leasing at leases or a lease rate at a rate that was very, very low. So we took the rent up. The rent's now about $13 million. The old tenant's rent was maybe $4.5 million or so. So basically, moved that up dramatically, and happy to do that. I can tell you that doesn't happen very often, but it was a neat opportunity we were able to find in the portfolio. And then jumping forward to retail, I think the one that's closest to home here happens to be on the left, San Jose Market Center, for those who know San Jose well, very near to downtown on Coleman Street. But the type of property we like to own, well anchored, doesn't mention here, but Target's part of the anchors, Sprouts, the grocery stores, Trader Joe's is in there. So a lot of, daily activity has performed. We've owned it since, 2010, really about the start of the fund, and has performed very, very well over that time. Kind of the type of stability you would like in a grocery anchored center. And you generally would like a market like San Jose, which is a very healthy market. We note affluent markets here, but very healthy market with regard to disposable incomes. Similarly, Greenway Commons is in, one of the stronger sections of Texas. Costco is the big traffic driver there. South Bay Marketplace is down in Redondo Beach. Nordstrom Rack and Sprouts are drivers there. It's another grocer. And then for those who know grocers on the East Coast, Wegmans is generally thought of as, I'd say the best grocer on the East Coast, and is kind of a cultish following. So the Wall Street Journal had an article on them a little while ago now on Wegmaniacs, as to how far people will go just to shop at Wegmans. So this is also another very strong holding. You can see 100% lease, but we have very stable, highly desirable retail, generally with grocers again and affluent markets.
Yeah, we can jump into life science, medical office, and traditional office. Again, our approach to these are defensive and looking for really high quality tenancy. In life sciences, we'd really target the primary life sciences markets. So think, San Diego, La Jolla, or Cambridge in Massachusetts. Those are the areas we're looking at. And again, really looking at the tenancy closely and making sure it's investment grade or, really high credit, which we have in our large exposure to Lumina, as we mentioned. On the medical office side, a few examples here, but again, great tenancy. Memorial Human, which is a large asset in Houston, Texas, on the Texas Medical Campus. A+ rating. They actually expanded to another floor in the asset last week, and so they keep doubling down on their exposure there. But again, a great tenant and a great credit-rated tenant. Vanderbilt University in Nashville has continued to expand at 100 Oaks, which is one of our really strong performing properties. And again, great tenant, great investment grade rating there as well. And as Jim had mentioned, a lot of private pay exposure. So we feel good, and that's been a defensive position. On the traditional office side, again, we've tried to be underweight there. I would say when we do invest, strong tenancy, obviously, but we do it in boutique sizes. So you're not going to see a lot of 400,000, 500,000, 600,000 square foot battleships and CBDs. That's not really what we're looking for. So on the slide as an example, in the North Loop T3, which is the most desirable office submarket in that NSA, 200,000 square feet. That's actually larger than a lot of our office exposure. We have a great asset in Denver. That's the asset that recently leased to 100% with a tenant this quarter. That's around 120,000 square feet and 2 blocks from Union Station, which has been a great repositioning in downtown Denver. So boutique office sizes, great tenancy, and walkable to good amenities.
And then fund terms, and won't spend a lot of time on this, but just a high level view. I've talked about some of these before: leverage, minimum investment, $5 million, et cetera, et cetera. Notice the quarterly rhythm is how we tend to work. So subscriptions on a quarterly basis, redemptions on a quarterly basis, reporting, valuations, which are appraisals on a quarterly basis, and distributions. So I'll point in particular subscriptions. The quarter that you commit in, basically everyone that commits in that quarter is treated in the same way. So their commitments are called on a pro rata basis. If you commit in a quarter later, then the first quarter, the quarter prior to that gets fully called. And similarly, if you're ahead of others, you get fully called before quarters that are subsequent to when you commit. In terms of cash flow distributions, we do fully distribute our NOI. So that generally, as we talked about earlier, running today at about 4.5%. There's an option for dividend reinvestment for those who desire that. We do note our fee schedule here, and have noted previously that it is competitive. So obviously, that's something that you can compare to others. But also want to just remind that we only have one fee. It's only an asset management fee, and there is no financing fees. Some have performance fees, acquisition, disposition fees. We have none of those.
Mm-hmm. Yeah, and then if we go forward a couple slides here, just fund leadership team and what LaSalle Property Fund looks like. I mean, first, what I would say is, it's not just the fund. You get the benefit of the entire platform at LaSalle, which is a large, 300 folks in the Americas. Leadership team, as Jim had mentioned, is Jim as portfolio president. I'm co-PM, and then Ryan DeRoos is our CFO. And as you can see, all of us with a lot of experience, both in real estate and very long tenures at LaSalle. I'm actually the lowest at 17 years at LaSalle. So good tenure at the company. We do have a dedicated team. Kevin and Nana really help out with support, a lot of investor relations, answering questionnaires, and doing a lot of great work for us, and then a lot of accounting that's fully dedicated to the fund. And then you can see our investment committee, again, with a lot of years of experience and good diverse representation. So, senior leadership, head of debt capital markets is part of it, head of asset management, and we're very into getting operations involved in all of our investment decisions, other fund managers, and so very diverse, very broad, and again, getting exposure to the broad platform. Lots of folks in asset management, as you can see, who are very specialized in all the assets that they oversee. A large acquisitions team who is our product specialists as well as geographic specialists. So, a lot of deep knowledge across the platform that we get to leverage, on the fund.
Great. I think that was, we do have some on the larger platform, LaSalle, and our bios in the back, but we hadn't planned on covering those unless you'd like us to.
Okay.
Thank you.
Any
Thank you.
questions from any of the trustees?
I sort of had a random question that I thought of while we were looking at the individual strategies. Would you say what sector of the core sectors would be the most encumbered? Which one has the most kind of leverage in general, just broadly?
That's an easy one. That's multifamily.
For us, yeah.
Yeah.
Multifamily.
Okay.
Yeah, we tend to have the best terms, so we go where the, from a debt standpoint, we want to go where the economics are the best.
And is that is that still in the 30 range? I mean, I sort of would expect maybe it's a little higher than that. Like,
we tend to, when we do leverage, those 30, our overall portfolio leverage is 25%.
yeah.
And when you look at individual assets, and then I would say right now about half of our financing is at the portfolio level. So let's put that aside. So maybe 12.5% of the 25% is at the property level. And when we leverage at the property level, we generally leverage to about 50%.
Gotcha.
Just so we don't have, because when you do have leverage, it does, it does encumber the asset. And so if you want to sell it or move on or something, you have a little bit more difficulty. So we try and go up to 50% because we can get kind of best rates, and also allow us to, as we wouldn't want to do 25 or 30% individual asset and then have the leverage spread across, a broader number of assets. So generally it's 50%.
Gotcha. Thank you.
Yeah, one question here on the fund team. Jim, can you just, we spoke at the last meeting with the board about kind of the recent personnel change. Obviously you and Pat as co-PMs. Can you just talk about that sort of open position and kind of the update there?
Sure, yeah. We, in adding Pat to the team, and prior to that, there's a young lady, Frida Deli, who was the co-portfolio manager, but she's taking a leave of absence, medical-related reason, and the time for return is actually, not absolutely certain right now, so expecting it to be, more than 6 months. With that, we named Pat to the fund, but also because we're growing the fund, we wanted to add a deputy portfolio manager. Frida had served in the deputy portfolio manager capacity, so by adding Pat, we've added, more to the, portfolio manager side of things, which I welcome. There's so many hours in the day, and having Pat on the team is great. And then also we're now looking to hire a deputy portfolio manager who, will be a significant contributor over time, but, not, the nature of that position is someone that probably has more 12 to 15 years of experience. So, Pat has more experience of that, has led the transactions team, and previously worked on the fund. So he's, kind of impacting the fund meaningfully. This role will be one that will impact the fund meaningfully over time, but someone who will be an internal hire, but will be new to the fund.
Do you have a timeline for when you expect that position to be filled?
How many days do you think?
I think it's 2 weeks. I mean, we're in the final rounds of interviews right now, so it's imminent. We're pretty close.
There was strong interest, right?
We had very strong interest. We had about 15 folks internally at LaSalle apply for it, so a lot of interest, which is great. We had a lot of great people applied for it.
Okay, are there any further questions? Thank you very much for your presentation.
Thank you.
Thank you.
Yeah, really appreciate the time.
Yeah.
Yes, thank you very much.
Yeah.
Absolutely.
Yeah,
Thank you for
Happy
the
to.
compliment again. Yeah.
Tell my mom as soon as we get out of here. Thank you. Thanks, sir.
Thank you.
Thank you. Take care. Yeah. Thank you very much. Yeah. Thank you.
I did not have my microphone on.
Thank you.
So we are still,
You're rolling.
yeah.
I'm good.
Alex, I have a 1 o'clock.
You have a 1 o'clock.
And I have an airport run.
Okay, so, what do we do? What are our options?
Right now,
Um,
we have to know if we have to keep.
Where is Trustee Kelly?
I think his camera is off, but I don't know. It says there's 5 participants there, but I don't
Okay,
know.
I'm gonna need to hear from Trustee Kelly.
Um,
We have a quorum right now.
Correct, but I was told that
I've had,
trustee
Okay.
Koscheck has to leave early.
Yeah.
okay, so not hearing from Trustee Kelly, what we're gonna do is push forward.
There he
There he
is.
is.
Okay, there he is. Okay, so we will have a quorum going forward, right? 1, 2, 3.
Yes.
No.
Session.
Oh.
Yes, are we gonna do that first?
Not right now.
Or
Oh, yes, we do have a quorum.
Okay,
Yes, with Charles. Yes.
until about 1 o'clock.
We will have a quorum even once
Once
Mr.
Charlie.
Haschek leaves, since Charlie is available remotely.
I have an airport pickup in Santa Rosa
What time are you leaving?
1:30. I'll make them wait.
Um,
But
Do you want to do the closed session before, right after Callan finishes? Because everything
can-
else on the agenda can wait till later.
Okay,
But that way you ensure you have a quorum for the disability item.
yeah, so we'll do that. We'll finish, can we finish item E here? We can
Yes.
finish this. I hate to rush this item. And then we could probably even circle back to F, I assume. So we'll just break right into E and go as far as we can here, I suppose. So this is core real estate manager selection discussion, led by Callan.
Great. So we heard from the 3 firms, Barings, Principal, and LaSalle. As a reminder, we're exploring replacing Barings for a few reasons, and we heard from them on these topics. One being performance, right? The second being personnel turnover. Chris mentioned the departure of Deb Schwartz earlier. And 3 concerns around shrinking fund size, and that's tied to the exit queue, right? So those are kind of the 3 reasons that we're considering replacing them. The performance has been baked, right? We've experienced that. Chris spent a lot of time talking about the efforts put into repositioning the portfolio. But I think the concerns with the, potential impacts of outflows remain. So that's kind of the key concern there. Between Principal and LaSalle, we like both funds a lot. We think highly of the strategies and the teams. We think either one would be a good selection for your portfolio. I guess I would differentiate the 2, and then I'll turn it to Aaron to go into more detail. But overall, Principal, very core focused. They're diversified by region and sector, and they're very aligned with the Odyssey, right? Differentiated from LaSalle in that we heard that, LaSalle has a pretty meaningful meaningful exposure, I should say, to alternatives. That's kind of their differentiator. They've had very strong performance. They did have a recent team departure, and so they spoke a bit about that at the end. But when I think about these two managers kind of in the context of your portfolio, and Aaron mentioned this at the outset, I think one thing to consider is that alternatives exposure within the LaSalle portfolio that is really interesting, and I think a key diversifier for them is also something that we can get, or that we will, get in that core plus exposure when we add that piece to the portfolio on a go-forward basis. So I'll pause there, hand it to Aaron if there's anything else you want to add.
I'll keep it really light here because I know we want to spend the bulk of this time kind of deliberating. If we could just go forward one slide. We looked at this earlier. I still think this is kind of probably the most important slide as we think about these hypothetical portfolios. So we don't have to look at anything else in the rest of the deck that we prepared right now. Aside from kind of how these hypothetical pairings would be differentiated, whether you choose to stick with Barings or choose to replace them with LaSalle or Principal. I would say with any one of these combinations, you'll have a slight overweight to industrial, largely due to DWS's position. So that's something that I think is pretty similar across all the options here. The multifamily allocation, I talked about this earlier, but you'll be slightly underweight with any of these combinations. Again, we can address that in the core plus search with some alternative residential exposure. Principal looks a lot lower, but as we talked about, manufactured housing and some of these other alternative sectors that are within the housing bucket helps bring that up to a roughly equal weight. So it'll be similar to what you see with the DWS LaSalle combination. Retail, you're kind of in line with all these combinations, although Barings has a higher retail weighting at 16%, which brings that a little higher. And then the office sector, Principal has the highest office allocation, and we talked a lot about that during their presentation and kind of the strength of their office portfolio and kind of the differentiators that they have with their holdings that tend to be pretty high quality. So those are kind of the main differentiators with each of these hypothetical combinations that I would just keep in mind as we're sort of comparing the different groups. But again, at this point, with obviously Barings well, gotten to know Principal and LaSalle pretty well over the past couple months, and both are very strong candidates. So
Aaron, can you also touch on fund size, because that's a key differentiator with Barings, and one of the reasons we've had reservations about them as their Q is significant relative to fund. So fund size, but then also the fees.
Yeah.
That might be that's the hard to read chart there.
Yeah, so for fund size, I do think this is a pretty important point. Both Principal and LaSalle are about the same size, much larger than Barings, but not quite as large as DWS, kind of around the median for Odyssey as a whole. We talked about this in the last meeting, but the issues potentially with the smaller fund size is lack of diversification within their investor base. That concentration can lead to some challenges from a capital flow standpoint with redemption queues and things like that, as well as diversification across their assets. So we talked about this a little bit during the meeting, but self-storage, they have one self-storage asset, and it's 100% concentrated in the city of Los Angeles. So if tides turn in certain markets, that can have a disproportionate impact. Similarly with retail, which is 16% of their portfolio, it's concentrated in just 5 assets in 4 markets. So there's a lot more concentration that comes with the smaller portfolio relative to Principal and LaSalle, which have much larger portfolios in terms of asset size and therefore much larger sort of embedded diversification. From a fees perspective, they're all relatively similar, so I don't think there's really a significant difference in terms of the fee schedules across these 3 groups. So I don't think there's anything that would really kind of put you over the edge in sort of a tiebreaker scenario here. Barings did talk about their 40 basis point offer, so we wanted to clarify that. That is applicable to new commitments. So if you were to give them an additional commitment on top of what's already invested, that would be subject to that 40 basis points, but your current investment with Barings is not subject to that 40 basis point tier.
Where's the fee in here?
Page 13.
So I was trying to find it out to 11, no wonder.
Yeah, sure. So on a hypothetical $30 million commitment, we're looking at for Barings about 85 basis points, including that 10% performance fee reduction that they offer. If the performance was in line with sort of expectations going forward, that fee would be really in line with the other managers. And then for LaSalle, we have 93 basis points and principal 95 basis points. Again, on a hypothetical $30 million investment.
What benefit, if any, does the potential for being on an advisory committee hold?
Yeah, so all these funds have advisory committee meetings at least once a year where you get to meet with other investors. It's kind of a closed session comprised of the largest or more sort of involved investors. So kind of just meeting with your peers, you get access to information that maybe is not shared widely in the quarterly reporting. Potentially the ability to, express your views or opinions on the fund directly to the fund team in ways that it's sort of just in a different format than you could as a regular LP that's not on the advisory committee.
And you say all three of them actually have advisory committees?
Yes.
But you don't just show up, right?
No, but I mean, the one firm had said, we have an opening on the advisory committee, and that was all I'd heard for advisory committees of the three presentations. That's why I wanted to clarify.
Yeah, it does not sound like LaSalle or Principal is offering a seat on the advisory committee, and I would generally say it's because they typically offer those seats to their largest investors. So sometimes there's a commitment amount that's tied to that. And let's say you got to be a $100 million investor to be on the advisory committee. Barings as a smaller fund, you might be closer to that sort of higher level tier.
Do you know if that's like an observer seat or a voting seat?
It's a great question. We would need to check with Barings on that.
Okay.
Typically,
And for
if it's
council, one of the items discussed at the Nossaman Forum was potential liability and not wanting to have serving on advisory committees in a voting capacity, but it was okay on an observatory basis, and I just wonder if you have an opinion on that.
I do not, but we can certainly cross that bridge and I can delve into it. I've never looked at that issue, but if that's something that the board is interested in doing and we move in that direction, I could look into it.
Robert, do you serve on that committee?
That makes the most sense, I
Yeah.
think. Yeah.
Yeah.
And I think that's also the implication. I'd spoken with Chris about that. So, yeah.
Well, you wouldn't serve on the committee if we're not sticking with Barings, though.
Yeah.
So where it's a little bit premature
Sure.
to decide
Sure.
which seat you're going to
I'm
sit
not
out.
deciding that. Well, I'm not deciding
I
that.
asked,
Yeah.
I wanted to know if staff
Yeah.
can.
Okay. So I guess that means we should probably open discussion on this. Are there any thoughts that trustees would like to share?
I like the perspective of that 100,000 network of LaSalle
Okay.
for getting even more sense of at least certain sectors, the information of what is happening. Yeah, LaSalle. Jones Lane.
You know, originally I was down on Barings. I didn't even think we should interview them. But then after hearing their spiel, I could understand where they're coming from. And for most of the stuff, it's just like, okay, office is one thing. But, all of the things, they're all kind of the same as far as what they're investing in, I think.
There's a lot of overlap in those segments of the market, in part because they're all part of the Odyssey index, so they all have to have certain allocations to different types of markets to be part of that Odyssey index. So you will see a lot of similarity in the overall asset allocation to those segments of the funds between them.
Yeah. And I guess I think it was the last one, LaSalle was investing in the individual homes, right? It sounded like.
They have over 1,000 individual homes in their portfolio for
Average.
$300-something million.
Yeah, average price $346,000.
Right. So, I mean, that is, a concern of mine. I asked that question up front to Bearings, and the information was provided by the other two. I don't particularly love that in there. It's not a deal killer, but I personally don't love that in this part of our portfolio. There's various reasons why I don't. It seems hard to manage. I don't know if you would be hiring, these individual properties all over the place, hundreds of them.
They're more like large developments.
Well, it didn't seem like they were. That's what I thought too, but it didn't seem. It seemed like they were individually located.
They were
properties.
scattered. In
That's correct.
That's what he said, scattered.
Yeah.
Oh,
For LaSalle.
LaSalle was more
Right.
scattered.
LaSalle.
Yeah,
Yeah.
so-
So, we've heard some nice words about LaSalle and about Bearings. I actually liked, I hate to say this, the principal presentation. It felt to me, their portfolio, their size, their organization seemed like the one that I would like the most off the bat. Now, I had written down a few items like that. Does anybody else have any feelings about the principal presentation?
I thought it was good.
I did too.
They're big. They got background information and data.
They had all their properties listed. They don't have a huge exit queue. They seem to have managed their entry queue. The talk about not growing or
Telling people
we can't take your money right now seems like a very responsible position. All of these three seem to be well positioned for pensions, for pension portfolios. Management. It seems like that's probably part of their business plan. But I liked that. And it seemed like a very responsible position to take. Their office exposure is higher. I don't want to get into a situation where, like with Bearings, where they have to drop a bunch. It didn't seem like they were doing that, although they were seeing a decline in the rates of, even though they had renewals, it was at less floors.
Well,
less space.
I would say, they still had a reasonable drawdown over the same exact period that we saw our two strategies.
Bigger even, yeah.
Well, about the same as Reef. But, here's the thing with Principal. They've had 2 additional periods of drawdowns. So my calculation through Q1 25, their drawdown's 21%. Versus somebody like Reef, who's just under 20%. So it's a little bit more. It's not a whole lot more.
Right.
To your. Go ahead, finish.
No, I'm
to your data, your number there. I went ahead and charted everybody. I took what Callan had put in their report for Bearings and PREF, and then the principal, and then LaSalle, and LaSalle beats everybody on 10-year, 5-year, 3-year, first 1 year, and last quarter, according to their information in their book. And so they beat Principal by 30 points, or 0.3%. They kicked their ass on 5-year by at least 25%. In 3-year, they lost the least of anybody by 20%. Last year, Bearings did better by 25-30%, but they were the next highest by 30%.
You mean percent or points?
No, I'm talking percent. Taking like 1 versus 3 is 30%.
Oh.
Okay.
You're talking about
Well,
percents
that's
of
60%.
Basis points.
That's why we use the basis points terminology.
But and in the last quarter, they're in basis, 1.49, or is that listed as percentage? It is 1.49. Bearings was second, 1.09, and then there wasn't a listing for principal for the last quarter. But it just looked to me like LaSalle performed reasonably better in all the periods. And I kind of like where they are, and bragging about having big buildings and big companies doesn't buy it for me. Yeah.
Well, so for comparison's sake, LaSalle's drawdown for this period is 17%. So it's definitely lower than the 19 we saw for Reef or the maybe 20 for principal. Of course, Barings closer to the 27% for that period. You know, and part of that drawdown is you know, in part the lack of the office exposure, but you know, probably also the tenancy too, right? I mean, some of that tenancy factor probably is playing into that a little bit as well.
If we were to take our money out of Barings, and they were saying, Chris was saying that, you know, they're not really pushing it, or, you know, what's the timeline on that?
Timeline to get your money back?
Yeah.
Great question.
Chris said he thinks he'll be able to pay down the redemption queue in full by mid-26. But that's not including any additional requests that might come in, including yours.
Yeah.
So if we do that and then commit to somebody else, do we need to give them a check right away?
Not necessarily. There's a minimum commitment, but if the assumption is that you will be funding that over time based on the distributions from Barings, those managers will gladly accept your money at any time.
Okay.
So you can kind of phase it in.
I'd like to hear what Charlie has to say, because he's one of our real financial gurus who lives this day and night.
Well, as I think I said last month or so, the principle is just fantastic long-term standard regular results. For consistency, there's no doubt they're the winners, but they're also playing it safe. Personally, I like LaSalle because they seem to be aggressive.
Yeah. The alternative, we don't need a core plus if we take LaSalle.
I would still consider the core plus strongly, very strongly. I think the biggest plus for the core plus is just having another manager. I think it helps us more, than anything.
And I'm fairly certain that of the core plus managers coming in next month, there are some that don't super overlap heavily with the other exposure that LaSalle has, so you could get some further diversification there. But you would want to, be mindful of the type of other non-core assets that LaSalle may be slightly heavier in compared to what you might be looking at with some of the other core plus managers. But
yeah, we would.
So if we were to do that, though, we would drop to a lower tier on the fee schedules. I would assume we would be splitting the total. I've been thinking that we're in the $30 million range. Then we would be in a lower tier.
I believe that would be the understanding. Is we currently have roughly how much total in there? 60?
Total?
60? 70 something?
70.
And that 70,
no, total,
for
total,
real estate, for real estate.
34.
And
34.
I think that 70 million would stay, but it would be split differently between the three if you went with
I'm looking at
right. So you may end up in the 100 basis point instead of the 95 or something like that, depending on the total you end up investing.
Assuming that the 34 that we have in Barings, give or take, would then be approximately cut in half if we were to add, and that's not what we're doing.
I don't know what I'm saying.
Okay.
Maybe it's also pulling some from Reef to fund your core plus. I think you would need to direct that to Callan as far as what the intent is.
So we would be
there.
looking at an overall balance move in that case. Okay.
Yeah, think about it as a third to three managers of the 70 that's there.
So each might be around 22 or whatever million.
Which I think brings
Plus or
up a
minus.
question I have. Do we need to make a decision on whether we are going to add the Core Plus today in order to make the decision about who we select?
I think technically you don't, but it might be something that you want to have in your mind when you're selecting maybe your core managers, if you are thinking that you'll be adding Core Plus. But I think Callan's point with these three is that any of these core options would mix well with potentially the Core Plus options that they're bringing, so it's not like a one or the other situation there.
Yeah, and I think when we met last month, we talked about, well, should we have the Core Plus come in first or the Core come in first?
Order of operations.
Yeah, exactly. And at that time, the group came to the thought that if we pick the Core manager today, that'll be good information for the Core Plus manager when we do interview them.
So pick a core. So that by that we would pick a core today.
Yeah.
And then if we don't like anybody in the Core Plus, that person would receive the entire. That's clear enough for me. At this point, I don't know if anybody else has anything else to talk to. I would be asking somebody to make a motion.
I move we go to LaSalle and dump bearings.
Okay. We have a motion to move to LaSalle and dump bearings. Do we have a second?
I'll second.
Now we would go to discussion on this item. And is there any discussion on this? I would say I liked principle, but not so much that I wouldn't yield to the other trustees in this case. Normally I don't do that, but in this case I would. Because I don't have a strong feeling and I can see the logic in either side. Both strategies are so similar. So does anybody else have any thoughts on the item?
Anything?
No.
So the motion is to dump bearings and add LaSalle. And at this point, we do need to ask for public comment as well. I believe, Jeff, public comment? Is there any public comment?
Participant list. So Hannah.
Oh,
So
it's
just
you.
us. Yeah, it's just us.
I'm sorry, I thought,
Okay.
I was not
So there's
counting you.
no public comment.
There is no public comment, so at this point, I would just ask for Judy to take a vote on this.
Mr. Kelly?
Aye.
Mr. Hashak?
Aye.
Mr. Shoemaker?
Aye.
Ms. Harris?
Aye.
Mr. Land?
Aye.
And Mr. Swope?
I don't think I get a
You
vote.
can't. You
You
can
do.
vote because we're missing 2 elected people.
Okay.
Because
Aye.
Catherine
Aye.
Cavanis and Quincy Cromer are
Okay.
missing.
Aye.
Thank you. Approved.
One of those quirks.
Okay, we're just going to plow right on through while we have a quorum. And should we skip item F and move straight into closed session
If
and
you
come back?
want to get it done while you might have the majority of your quorum here, I would say yes. Let's skip to the closed session. We can lock the meeting, then we'll
Thank
come
you.
back to everything.
Okay.
Seeing you.
Okay.
Great to see you.
Thank you.
See you in a month.
Okay, thank you. Bye, Hannah.
Bye, Hannah.
Bye, guys.
Okay.
We will be going offline.
So, is Robert leaving?
Can you kick him out?
Why is he still up there?
Because he didn't
I had
leave the
some of the concerns that you did.
Judy, let me know when I've got the green light, please.
Yes, just give me a few minutes, please.
Oh, no, you gotta log
Pretty
in.
much.
This is actually item, are we ready to reconvene? Okay, we're reconvening
Okay.
in open session. And this is moving to item 11, Attorney Jeff Burke.
Thank you. In the closed session item, the board voted unanimously to grant a service-connected disability retirement for Joseph Comer.
Okay, thank you very much. And now we're going to move quickly to item 4 you wanted to go to.
Yes, thank
Pension
you.
Determination of Family Assistance Health Plan.
There is a new pay code being created by the county. There is a memo in your folders and in the 2 resolutions that need adoption. This pay code is non-pensionable. It is a reimbursement of insurance premiums for certain qualifying people.
And I read through it. I think we can just go straight to a motion. Can I offer a
Staff
motion?
recommendation.
Second.
Okay.
Judy, roll call, please.
Mr. Kelly?
Aye.
Mr. Shoemaker?
Aye.
Ms. Harris?
Aye.
Mr. Swope?
Aye.
Mr. Land?
Aye.
Thank you, approved.
Okay, and I believe item 5 also,
Correct. Item 5 is just an update to the board's election policy. This would need to be adopted by the board. The change here is that it would allow the board to appoint someone to the retired alternate seat if there happened to be a midterm vacancy in that. And it just aligns with the Cyril. It was something that was overlooked and not included. And so it just aligns that with what's allowed in the law. So we wouldn't have to run a special election. If it was the retired alternate seat, it could be an appointed by the board.
okay.
Move approval.
Second.
Okay.
Judy?
Mr. Kelly?
Aye.
Mr. Shoemaker?
Aye.
Ms. Harris?
Aye.
Mr. Swope?
Aye.
Mr. Land?
Aye.
Approved.
Okay. I don't believe that there are any other items that required.
The remaining actions are informational or for direction, and I think we can continue without a quorum. Is that correct, Jeff? Or would we need to just put those to a future meeting?
Which items are you referring to?
Well, item 3 is informational. It's the budget update. And then items 6 through 9 are informational and/or requesting direction from the board.
I recommend waiting.
Okay.
That's very
We can add all of those to the October agenda if the chair wishes to table those.
Yeah, it seems like the best, most prudent course is to table.
The next meeting will be also very long. Trustees need to make
So,
sure to have the time
I
to
had,
have
yes,
a
I
meeting
had in
without other
fact
things going on.
intended to comment on
I
that.
didn't set up what I meant to do
Just
today.
just everybody, yeah.
So we'll move straight to item 12, which is adjournment and notice of next Board of Retirement meeting. All items that were not viewed today will show up on the next board meeting. The next Board of Retirement meeting will be held in the Mendocino County Employees Retirement Association Boardroom, 625B Kings Court, Ukiah, California, on Wednesday, October 15th, 2025 at 8:30 a.m. Thank you.
Maybe next, if it's gonna go like this, maybe we can have lunch or something so we don't have to